bit on the back of that softer CPI print out of the UK. 507 on the 2-year. The pound at 123, taking a knock. Again, softer inflation. Markets now readjusting their forecasts for the BOE and pushing back the view that maybe you get an additional hike after tomorrow. There's currently a 70% chance coming through from markets of a hike tomorrow, down for 90%. 123 on the pound, down 0.3%. Oil is in focus. The shock around the oil price rally, 30% or so since June, of course, in terms of the headline inflation, but coming off in the session today, down a full percentage point at $93 a barrel. Let's take a look at the futures then. You ended lower across the European session yesterday, but not by a great amount. It was retail that was at the bottom of the list, and banks at the top. DAX futures pointing to gains of 0.2%. Let's see the open then, as futures then point to the upside. We're weighing up, of course, softer inflation out of the UK, a reading and leading up to the Fed's decision, with a particular focus on the dot plots. Are they going to continue to keep the door open to another hike this year? Are they going to walk back the views, the dot plot forecast around 100 basis points of cuts next year, and try and align more with the higher for longer narrative around rates? FTSE 100 currently posting gains of 0.4%. By the way, iron ore has ticked up as well, so we could see basic resources as a sector rallying in the session. There was more support coming through from China for the property sector. Over in Spain, the Spanish index up 0.2%. In France, the CAC 40 was off by 9 points. And the FTSE in Italy is currently flat. Let's have a look at the sectors then and see how things are shaping out. Again, yesterday, banks posted gains of 1% in an otherwise down session for European equities. Retail was soggy. Currently, technology is gaining about 0.1%. Basic resources up 0.2, so you're getting a bit of a lift from the higher iron ore prices coming through on the back of that. Further support for the Chinese property sector. Energy, though, is down 0.8, taking a breather again on the back of at least temporarily softer oil prices, back at around $93 a barrel after breaking above $95. Goldman Sachs, though, coming out with an adjusted forecast. They do now see triple-digit oil, so they're coming back to that $100 a barrel call from Goldman Sachs. Construction is taking a knock by 0.5%. Retail is getting and pairing some of the losses of yesterday, posting gains in the session today of 0.6%. Some other standouts across these sectors. Autos gaining 0.4. You saw some auto registration data out of the Eurozone. 13 straight months of a pickup in terms of registrations, with double-digit growth in the EV segment. Let's flip the board and have a look at how gilts are treating. We know, of course, the pound has taken a hit. Inflation out of the UK, much softer than the estimates. The core, softer than the estimates. We expected a bit of pickup in terms of the headline on higher energy costs. Bloomberg Economics had pointed to the fact that goods inflation is easing. This is good news for the BOE, arguably, and is certainly good news in terms of the politics of the UK for Prime Minister Rishi Sunak from his position, given his determination to halve inflation. The Bank of England, of course, their decision tomorrow. 488 on the 2-year, so that's a move of 10 basis points in terms of the front end of the curve. Yields coming down on the back of that softer inflation print. In the belly of the curve, 447 on the 5-year. You're moving lower by 6 basis points. In the middle of the curve, the 2-year is where the action is today. 488, comfortably back below that 5% level. Let's get more analysis now and bring in Noor Al-Ali from our MLive team. And let's start with UK CPI. Noor, how much of a surprise was this? Well, we know it was a surprise, but how do you think it leaves the views on the Bank of England? Traders are adjusting their views on what happens tomorrow, but arguably more important, the forecast around where the BOE goes beyond that decision tomorrow.
Absolutely, Tom. I mean, look, we're in a situation where good news is bad news, right? We've had inflation come in lower than expected. You've seen core, you've seen services come off their peaks. You know, it's an excellent situation for the BOE to be in at the moment. But the question is now, has the market underpriced the risk of a hold tomorrow? I think so far you've seen that reaction from money markets, as you've just said. We've seen odds of, comparatively, there were 90% of a 25 basis point hike tomorrow. Now they're down to 70, and I think now there's also potential for at least one more hike into the hiking cycle by the BOE until we reach that peak in Feb, which is now seen much lower.
You think there is the potential for another hike beyond tomorrow from the Bank of England?
Look, I don't know. I mean, the Bank of England generally does lean more dovish than the other central banks that we've seen. We've seen them hike more conservatively than the Fed and the ECB. We have seen, inflation be a lot stickier in the UK. It was among the highest in G10 economies. It's very difficult and quite tricky for the Bank of England now to say we're going to hold or hike. Their forward guidance is potentially a lot more data dependent now, right? We're starting to see inflation roll off, but it's not rolling off at the pace where I can see they'd be comfortable with, keeping rates cutting rates as soon as the market would expect them to.
And we look ahead to the Fed as well later today, of course, before we get to the Bank of England. The dot plots in focus, as well as the upgrades in terms of the forecast, or at least the updates, not upgrades, the updates in terms of the forecast. The dot plots, do you think they're going to be pushing back on the forecast that they put out in June of 100 basis points of cuts next year? Does that look like it needs to be adjusted?
I think so. I think we're going to start now seeing, and that's what the markets are also seeing. The dots are going to shift higher. We're going to see some expectations here from markets where the Fed continues to push back. It is higher for longer. They've maintained that. Powell has said that repeatedly, and we're going to see, an iteration of that tomorrow, at least from markets' perspective, where you see the dollar is really surging this month, and it's quite an interesting move. You've seen also yields push higher to cycle highs. The market is really gearing for that hawkish, even if it is a pause, it's definitely going to be a hawkish one from a market's perspective.
How much will the headline inflation question come back into play for central bankers, given what's happened with oil prices?
Look, it's all tying together, Tom, and those questions really point to that. You are seeing now oil really come back, and now we're talking about $100 per barrel. Yesterday, I wrote about, what happens beyond that? Are those gains sustainable? I think the question for oil, no, it's not, right? Because you are now it's no longer a matter of just inflation. We're now a lot more concerned about growth. And when it comes to oil hitting those, multi-year peaks, hitting levels that we haven't seen in quite some time when inflation is still hot, now we start being a lot more concerned about stagflation, and just how hard it is for central banks to shake those economies out of it is quite tricky.
And stagflationary risk certainly will be there if we get to triple-digit oil. That's the call from Goldman Sachs in terms of upgrading and updating its 12-month forecast for global Brent, and the benchmark, of course, to $100 from $93. That's the update from Goldman Sachs. When it comes to the Bank of Japan, of course, inflation dynamics very different for the BOJ, although the data suggests that inflation is starting to take a hold in Japan now. We're not expecting a decision in terms of the rates coming through from the Bank of Japan on Friday, but of course there is great anticipation about whether or not the next step beyond the meeting is going to be either an adjustment to yield curve control beyond what they've already done, or arguably more importantly, the ditching of negative rates. What are you looking at from the BOJ?
I'm looking for a surprise. Look,
You are looking for a surprise?
Yes, the BOJ has a history of surprising markets time and time again. They've done that with the yield curve control just a couple of months ago now. And I think now the BOJ has the biggest potential to really surprise markets this week. And I don't know, I mean, you look at the yen, you've seen those talks of the intervention coming up. The governor did talk recently that they've seen those exchange rates really starting to, take hold or impact their decision making. BOJ has a history of surprises, Tom.
No, I like that call. It's a bold call. Maybe a surprise coming through from the BOJ. Noor Ali, of course, from our M Live team. Let's check in on some of the individual stocks on the move now with Joe Easton. Joe, what is standing out to you?
So the best performing stock in Europe at the open of trade is Taylor Wimpey, the UK home builder, given the easing of bond yields after that softer than expected inflation data. We're seeing the whole sector, including Pearson and Bellway, also rising, and also the real estate investment firms as well. Taylor Wimpey now up almost 6%. Then a couple of other stocks we had in stocks to watch. M&G rising with their assets under management remaining at steady. Some of their outflows not as bad as people were expecting. That one extending its recent rise. While Pearson, the education company, goes the other way with a shock news that the CEO is retiring. They've managed to get someone in over from Microsoft, but that stock's done really well under the current CEO and is now falling around 4%. Then finally in the UK, we've got Finsbury Food, a maker of desserts, gets a takeover offer at 110 pence a share, rising 22% at the moment. Some of those investors having their cake and eating it too today. That one was a bit half-baked, but we're going to move over to a look. We're going to move over and look at the luxury. I had to get something on that one. We look at the luxury stocks. LVMH, Kering, Moncler, all three declining after Jefferies downgrades them, spurring concern around the Chinese outlook. So Jefferies noting that tourism spending from China has reduced so much since the pandemic and they haven't seen it recovering. Those ones declining as Jefferies puts out that bullish note. Finally, on this board, we've got UniCredit. They've announced that they have reiterated their shareholder returns target for the year ahead. However, potentially not as big as some analysts were expecting, and that one's slipping today. I'll have to dig a bit deeper into that one later this morning. Then we're going to have a quick look at some of the ratings changes. SocGen appears to be turning more bearish on the defense and aerospace sector. They're cutting Thales and Leonardo, which are both dropping around 2%. They go down to hold at SocGen, according to a note from them. WPP, the big advertising firm, downgraded to neutral at Exane BNP Paribas. We had a profit warning from S4 Capital last week, the rival created by their founder, and that sent the stock lower there. That one continuing to decline. Then Amplifon over in Germany, they are raised to buy at HSBC, and that one rising around 3% on the DAX index. Tom.
Okay, Joe Easton, thank you very much indeed. Good news for the luxury sector, though, is that you're going to be picking up another Birkin bag, I hear, Joe, which is very generous of you for your partner. Joe, thank you for walking through some of the stocks to watch, and don't walk back on that commitment. Here's what we're watching today for the first time in NHS history. Some of the other stories you should keep in mind. Junior doctors and hospital consultants in England, they're going to go on strike at the same time in a dispute over pay. That is a first. Then later in the evening at 7 p.m. UK time, we of course get the FOMC rate decision with economic projections. They're going to be published at the same time. The Fed's press conference comes half an hour later. We're looking for the dot plots. We're looking for the changes in terms of the forecasts on growth, employment and inflation as well. And after the US market closes, FedEx releases its first quarterly earnings. And finally, at 10:30 p.m. UK time, we're going to get Brazil's rate decision. The LATAM Central Bank is widely anticipated to cut its key rate for the second consecutive meeting. Now, coming up, leaving the door ajar. The Fed is expected to pause its rate hikes today for a second time, but potentially keep its options open to another increase as early as November. We get some analysis. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Wall Street is waking up. Europe is already trading. And Manus Granny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. Tuesday. Surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
This is Markets Today. 15 minutes into the European trading day, you're seeing gains across European equities of 0.2%. Across your sectors, real estate is leading the upside, posting gains of 1.4%. At the bottom of the list, energy currently down 0.8% as the run-up in Brent prices takes a breather. US futures are in a holding pattern ahead, of course, of the Fed's decision, the dot plots, and the changes and adjustments to their forecasts. Let's get some analysis now in terms of positioning in this environment. Bring in Daniel O'Keefe, who joins us in the studio, lead portfolio manager of the 23.6 billion global value strategy at Artisan Partners, joining us on set in London. Daniel, thanks for coming in. We appreciate it. I know you've been meeting clients, you've been having discussions about the current environment. Just start, and we'll start on the Fed and the expectations that maybe you're going to get another pause coming through, but maybe, and arguably more important, how they project into 2024. They currently have priced through the dot plots, or at least the forecasts from the dot plots, 100 basis points of cuts next year. Do you push back? Do you think markets are underestimating the resilience, the stickiness of inflation?
Well, I mean, we can get caught up in the sort of the short-term tactics of interest rates. I think the Fed probably will pause. You know, interest rates in the U.S. are closer to, you know, they're above the actual inflation rate now, which is different from what you have in the UK, where you still have negative real interest rates. And I think that takes pressure off the Fed to hike in the near term. I think they'll probably pause.
Is that a catalyst, a pause from the Fed at this point, or is it
I think people
very well signaled?
I think people expect it. But, you know, I think the larger issue just around inflation is to let's not get lost in the weeds, and let's look at the bigger picture. And I think the bigger picture is inflation is probably going to be here longer, and it's certainly going to be higher than what we're used to over the last decade. I don't think we're going back to zero interest rates anytime soon. There are a number of things that have changed structurally around the world, and I think those will persist inflation at a higher level than what we're used to.
What does that do in terms of how you want to position in that environment of more elevated inflation and higher rates?
Well, I mean, I think it creates competition for equities. You know, if you can earn, 5%, 4%, even 3%, on a risk-free basis, with treasuries or gilts, that's competition for equities. And equities in many pockets of the market are expensive. Other pockets are very cheap and compare favorably to those types of returns that you can earn risk-free. So I think you'll have more volatility. I think you have more competition for equities in general. And I think you'll have probably a more enduring focus on valuation, which is something that we haven't seen over the last 10
Is it proving more of a challenge to encourage your clients to put cash to play in this environment, given the yields they can get?
Definitely.
Money markets?
Definitely. Yeah, I mean, if you can earn 5% risk-free with the Fed, with tax benefits, you're a little bit more reluctant to buy the S&P at, 22, 23 times earnings?
And the undervalue in terms of what's happening and what's percolated through the European, and it's not just a one-year story, this is going back a decade.
Yeah.
But are you being rewarded? There's a reason why European stocks are undervalued, is the rationale from those who say you still need to have a heavy exposure to the upside coming through from the US. There's a reason European stocks are cheap, particularly now when you look at the fundamentals of the European economy.
Yeah, the European economy is much worse than the US, and that's not going to change. But what you need to look at is you need to look at businesses in Europe that have comparable business models to companies that are listed in the US and look at the valuation discrepancy. So at a high level, the U.S. market is worth more than the European market because it has growth and it has companies in information technology that will continue to grow. Europe doesn't have those businesses. But you can still go beneath the surface of that and find businesses in Europe that look very much like businesses that are traded in the U.S., business-wise, exposure to the underlying economies, and you can buy them much more cheaply in Europe than in the U.S. It's, in some cases, half the multiple. So if you look at energy, right, you can buy Chevron and Exxon in the U.S., at double-digit PEs, or you can buy Shell and Total in Europe at 5 or 6 times earnings, half. They're effectively the same business. There's no reason economically why they should trade at half the multiple, and there's no different economic exposure. You're not more or less exposed to the U.S. or Europe by
So you're buying European energy, and you buy it because of the cash return to investors, but you also buy it on the multiple story as well, and that comparison effect.
Absolutely. I mean, think about the power of Shell and Total buying back stock with their huge free cash flow generation at 5 or 6 times earnings, plus the dividend yield. I mean, the economic power of that is inexorably leading you to a strong return for shareholders.
How do you think about capital markets? We've been speaking to a number of people about, we've had ARM, of course, successful in terms of the listing. The price, of course, has come off in the last few days. Instacart yesterday. We've been speaking, Anna Edwards, my colleague, was speaking to Goldman's head of Germany and Austria about the capital markets and whether or not we're seeing a bit of a pickup. Let's just play the sound, and then we'll get your reaction, Daniel.
We saw already in the second quarter a certain pickup based on the fact that the interest rate hike cycle will come to an end, that we get into a more stable environment, and that therefore transactions can be priced again, and there's interest on the investor side. And we've seen the IPO markets have been super slow, but picking up recently.
Okay, that was Goldman's head of Germany and Austria, Wolfgang Fink, speaking to Anna Edwards in Frankfurt. Do you align with that view? Are capital markets starting to pick up? Are we going to see a run-up in terms of IPOs, M&A? Are things looking a little bit more active across these capital markets now?
Well, I mean, you know, you've had a shutdown of a lot of capital market activity. If you look at the investment banking results and capital market results of the major investment banks, they reflect that the shutdown, and it's because of the rapid rise in interest rates and everybody trying to reestablish some level of normalization. And if you have interest rates stabilizing or even trending down a little bit, I think it stands to reason that you'll see a pickup in capital markets activity. You're already seeing it. You know, you've had 2 big deals over the last week or so. That probably heralds a thawing of the freeze in capital markets activity. Sure.
Okay, Daniel, thank you very much indeed for joining us on set this Wednesday morning. Daniel O'Keefe, lead portfolio manager of Artisan Partners Global Value Strategy, with a very clear call there on the upside that he sees for European energy stocks in terms of the value play coming as a factor there. Thank you. Coming up, European car sales jumped 21% with electric vehicles driving growth. You saw a doubling in terms of sales of electric vehicles. We're going to get more on that next. The data, the context, can it be sustained, particularly as Europe takes on China with this probe? Stay with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
our companies. And what we see is massive subsidies in the EV sector in China, which is, of course, unleveling our playing field. And we do not accept this in the internal market for our companies. So we do also not accept it for Chinese companies.
European Commission President Ursula von der Leyen speaking to Francine Lacqua at the Bloomberg Transition Finance Action Forum. Now, European auto sales climbed for the 13th consecutive month in August, with electric vehicles both driving growth and becoming the latest focal point of global trade tensions, as von der Leyen was discussing there over in the US. Let's get the details then with Oliver Crook, who joins us from Berlin. Ollie, a strong top line then in terms of car registrations in Europe. Is the momentum still there to take us through the next weeks and months? Walk us through this data.
That's a good question, Tom. So let's deal with the top line first. 21%, another monster number for European car sales, adding to what has been a really strong year so far for car sales, but really down to a pent-up demand, which we are now working through. And so really the fear is that in the back half of the year is where you're going to get the weakness. Plus, that's when sales picked up last year at the end of 2022. So the year-on-year comparisons will be less flattering. A moment on EVs, they not only doubled in terms of sales in Europe, they also accounted for more than 20% of all the cars that were sold in Europe for the very first time. They overtook diesel by a significant margin. But let's just spend a moment on this sort of fear around Chinese automakers. They only account for 5.6% of market share here in Europe. If you're afraid of a foreign car maker in Europe, take a look at Tesla. The Model Y alone commands 13% of the market share in Europe. That means that it's more than twice all of the Chinese automakers combined.
Yeah, that really is a standout, isn't it? You'd imagine that might be in the back pocket of their Chinese counterparts when they move on to those discussions in Beijing. Ollie, what is the latest when it comes to the UAW strikes? I'm being told we have about 20 seconds on the clock.
So really, we're looking at Friday as the deadline. You know, there needs to be another offer put forward. There's not been a huge amount of motion in terms of how it's affecting the companies themselves. Stellantis says that they're doing okay in terms of inventory. We are hearing from some dealers that they're starting to run out a little bit of some stock. S&P Global says it's costing the big three 3,000 cars a day. So we're still watching it, and really Friday is the moment to look for.
Ollie Crook, thank you very much indeed on those registrations and the latest on the industrial dispute, of course, in the US. We're going to dig deep into the BOE. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
This is Markets Today, 30 minutes into the European trading day. Here are your top stories. The Fed is expected to take a breather on hikes for the second time this year, while leaving the door open to another increase as early as November. The pound and gilt yields slip as softer than expected inflation here in the UK builds the case for a pause from the Bank of England tomorrow. Plus, European Commission President Ursula von der Leyen is preparing to take the fight to Beijing on EVs, telling Bloomberg that Brussels will investigate Chinese subsidies. Let's check in on these European markets then. After the losses that came through yesterday, they were not heavy. It was a bit of a holding pattern ahead of the data. And we are getting the data through, of course, this morning in terms of the inflation print out of the UK and a surprise to the downside. Looking ahead, of course, to that Fed decision, the revisions that are likely to come through for those dot plots and the forecasts. Across the European benchmark then, gains of 0.3%, even as energy lags on softer oil prices, at least in the session today. The DAX over in Germany above 15,700, adding 70 points, a gain of 0.4%. And here in the UK, the FTSE 100 up by 0.6%. Worth noting that real estate is getting a lift on expectations that maybe rates are getting close to a peak, and maybe some of the pricing has been overdone as we weigh up that softer inflation print, adding 44 points currently on the UK benchmark, 7,705. Let's break down the sectors then as we dig in to the implications of this softer CPI print in the UK, and we'll focus, of course, on that real estate sector if it jumps out to us. Currently, I'm not seeing it, but I can tell you the last time I checked these sectors, it was the leading gainer, gains of more than 1%. Financial services are up 0.4%. Retail is getting a bit of a boost as well, adding 0.8%. On the downside, you're seeing losses coming through from basic resources. Iron ore prices have picked up, but basic resources as a sector currently down 0.4%. Energy is off by 1%, reflecting the downside coming through from Brent. Goldman Sachs, though, upgrading their forecast, a 12-month forecast, from $93 a barrel to $100 a barrel. So Goldman does see triple-digit oil. Other sectors that are standing out to me at the moment, autos, of course, being reflected in what's happening with the DAX, currently gaining 0.6%. That conversation that we had with the European Commission President on her determination to hold China to task on what she says are subsidies for that auto sector. And the banks, as a sector, gaining 0.8%. A reminder, across your benchmark, you're at 458 here in Europe, a gain of 0.3%. Now, consumer inflation in the UK has unexpectedly fallen to the lowest level in 18 months, easing pressure then for further rate hikes from the Bank of England. The UK has spent most of the year with the worst inflation problem in the G7. Can we put that stagflation risk to one side then, as you see a little bit more concrete movement in terms of the inflation fight here in the UK? The trading action in terms of the pricing, in terms of the forecast and the estimates for where the BOE lands tomorrow with that decision have been adjusted. There is now seen to be a 70% chance of a hike. That's down from the 90% chance. And then the expectations of hikes beyond have effectively been phased out now. Other markets getting ahead of their skis, or have the inflation dynamics actually concretely changed here in the UK to the downside? There is action, of course, in the gilts, money flowing in to UK debt, and UK yields currently at the front end, and this is where most of the action is. Yields coming in 12 basis points on the 2-year, 4.87. The implications then for the housing market, for those looking to remortgage, and of course for the banking sector as well. The 10-year at 4.27, a slightly more moderated move, but nonetheless 7 basis points lower in terms of the yields on the benchmark. 12 basis points, close to 12 basis points on the 5-year as well. 4.41 on the 5-year, 4.87 on the 2-year as markets readjust to this softer inflation print. Let's get more analysis now and bring in Victoria Clark, UK Chief Economist at Santander CIB. Victoria, thanks for joining us this morning. Have then the dynamics of UK inflation changed? Are you convinced that we are now seeing concrete downside in UK core inflation? Are you adjusting your views on where the BOE goes next?
I'm not convinced that this is, job done on inflation, but I must say this feels like the biggest amount of progress that we've had in a long time. And, on the one hand, you've got this horribly elevated inflation rate. I mean, when you're still, talking about core inflation with a 6 handle, it's still uncomfortably high. But, looking through the numbers as we've been doing this morning, taking them apart, working out where the inflation's coming from, the fact that you are getting inflation being pulled down in so much of that across that CPI basket suggests that we are finally seeing some progress and some progress in services inflation, which has been a really big focus for the Bank of England.
Well, let's unpack that, because that is really important. As you say, it's not a big surprise that goods inflation has come down. You're not convinced that the fights against inflation here in the UK is done and dusted, but you are seeing material progress. And on services, that is the really important part. We know how consequential that is, of course, for Andrew Bailey and other members of the MPC. What are you seeing in terms of services and the part of the component around services? Are we at a point now where that revenge spend has started to be eased out, where UK household spending, our balance sheets have softened to the degree where service inflation is now on a sustained downward trajectory?
I don't think we can say that yet, no. I mean, I'm reassured that we're not seeing the degree of strength that we were seeing in services inflation. But, you know, that what we know about the services sector is that it's softened. What we still have is a hell of a lot of labour cost inflation, which is very, very important for the services sector. So, look, it's good that we have these downside surprises in, restaurants and hotels, prices, recreation, these segments which are discretionary areas of spending, which have been super, super strong and have led us to feel really pretty twitchy that this services inflation is going to be very, very sticky. And now, we've had some fairly chunky downside surprises in these numbers. I wouldn't be surprised if some of them tick back up next month. And I still think that the risks are that, we make a bit of progress, but then we get stuck and, services inflation still doesn't fall as quickly as we'd all like it to.
Okay, so the concern there about the wage growth that we continue to see in the UK on the day when, of course, we're seeing another NHS strike as well on demands for higher wages. Victoria, where do you think this all leaves the Bank of England tomorrow then? Do they go ahead with that 25 basis point hike and then are they in a place where they can pause? What is your kind of view as you project out for the BOE?
So if you look back to August, what the Bank of England told us was we should watch out for what's going on with labour momentum, and that's certainly been softening. We've seen the jobs market softening in a number of surveys. They told us watch out for services inflation, and this is a pretty marked downside surprise versus what they'd penciled in for services CPI. So I think that is important. And then thirdly, keep an eye on the picture for pay growth, which is where they've had probably a bit more strength than they would have expected and would have liked. So it's a mixed picture, but I certainly think, if you asked me the same question 12 hours ago, I would have said, absolutely, this is a, straight in the net, 25 basis points, and there's no real doubt about it. I think now looking at that downside surprise on services CPI versus the Bank of England's forecast is going to be a really live decision. And, there will be a contingent on that MPC that are going to be saying, look, really, do we need to do this one? Could we sit tight and see what the data does for another month and come back in November? But I think probably safer for them is just to push on that open door, which has been, look, let's do this hike. We can sit tight, take stock of the jobs data, the services data for another month, and then come back. And if we don't want to do November, we don't do November.
Okay, so push on the open door, but really illustrating there with your response how finely balanced this decision is likely to be, Victoria. How concerned should we be? We reverse back, we look back, we move back 12 hours, and it was all about the oil price story. It was all about headline inflation. How much of a concern is that going to be in the months ahead, the pickup in headline inflation for the Bank of England?
I think it's important. I really do, because one of the narratives that they've had has been, well, look, headline inflation will start to fall, and then people coming to the negotiating table for their pay discussions will start to see lower inflation numbers, and that will all reinforce the downward momentum. So, to the extent that headline inflation numbers stay stickier, I think that just adds the risk that all of this inflation gets cooked in and would make you, as a central banker, probably feel like you want to be a bit more front-footed and really push a little bit more against those inflation expectations. So I think it's unhelpful for them. It probably helps with the macroeconomic backdrop that, the labour market's holding so strong as well. And I think, when you look at the pay growth picture, the real pay picture is relevant, but actually, what really is going to matter for them actually is, what happens with the headline numbers, but what's happening for underlying inflation. So it's unhelpful. It's not the big story here.
Victoria, you talk about wages, and that brings me on to an obvious question about the UK labour market. What is underpinning the relative resilience still of this labour market here in the UK?
Exactly. So I think the labour market story is a really interesting one because it's strong. But it's softening. So you get this really divided debate, and it's quite difficult to actually characterize it because, you know, we are seeing a softening. I think that's clear to see. How much of a softening and how quick a softening we're seeing is debatable, but it's all in the context of this really strong, resilient sort of starting point for the jobs market, where we've still got, you know, 1.4 vacancies per person unemployed. And that, you know, that is all telling you that your starting point is strong. You've got this buffer that's helped to underpin people's incomes, their resilience to this inflationary squeeze. And, you know, for me, and I think that the Bank of England have warmed up to this as well, it just means that you can push a little bit harder before you kind of get to your top of your table mountain and sit tight. So I think resilience has to be the thing that we've learned of the year, and you've got to remain mindful of that even as we see the jobs market start to turn. It is still strong.
Okay, Victoria, I'm impressed that you managed to get Table Mountain in. It would have been a disappointment if this conversation hadn't included a line on the mountain analogy. Victoria Clark, really smart analysis, and the reaction to this softer than expected CPI print out of the UK, the expectation that just about the balance will swing towards a hike from the Bank of England tomorrow, but the view that it is going to be very finely balanced. UK Chief Economist at Santander CIB with some really smart analysis. Talking the banking sector, let's have a quick look at what's happening with UniCredit, because that stock is rallying a little over 2%. Some lines crossing from the CEO, Orchel, on the return of cash to shareholders. UniCredit intends to increase its cash distribution. Orchel saying returns of at least 6.5 billion euros annually are sustainable. This is all part of the bank's plans to start a 2.5 billion euro tranche of this 2023 buyback. Also commenting on the Italian bank tax and saying it will not affect UniCredit's 2023 capital return. This is the CEO, of course, speaking on some of these tax implications and the return of cash to shareholders, saying he's very positive on the outlook for 2024. Again, the top line coming through, returns of at least 6.5 billion euros annually are sustainable, and the stock over in Italy gaining a little over 2%. Now, coming up, a rift between Canada and India threatening to grow into a full-blown crisis. It follows Justin Trudeau's accusation of Indian state involvement in the assassination of a Sikh leader on Canadian soil. What does it mean, though, for broader geopolitics, and particularly China and the US? Stay with us. This is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Markets Today, 45 minutes into the European trading day. You're seeing gains across European stocks of 0.2%. US futures are in the green, but largely flat ahead of the Fed's decision. The surprise to the downside, of course, for UK inflation as well, being factored into these markets with a big move into gilts, and yields are lower. To geopolitics now, though. Canadian Prime Minister Justin Trudeau has vowed to hold people to account for the murder of a Sikh leader in Canada, which his government alleges was masterminded by India. The accusation, which India denies, threatens to upend Washington's effort to court India as a counterweight to China. So far broader geopolitical consequences from this story. For more, let's bring in Bloomberg's Ross Matheson. Ross, what exactly is Canada accusing India of?
Well, quite publicly now, Canada is saying that India had a hand in the murder of this Sikh leader on Canadian soil back in June. That's Hardeep Singh Nijjar. Of course, he was a Sikh leader in Canada, but it's a very sensitive issue in Indian history and politics. He advocated, of course, for a Sikh independent state. It's called the Khalistan movement in India, and it was quite violent in the 1980s. In fact, when the insurgent leader was killed in India in the 1980s, that led to the retaliation of the assassination of the Prime Minister at the time, Indira Gandhi. So it's a really, really delicate political, historical issue for India. And now what we have is Canada saying publicly that agents of India went to Canada on Canadian soil and murdered this Sikh leader. Of course, allegations that India describes as absurd, but it's a very, very sensitive issue for both countries. And as you say, there are ramifications potentially far beyond their own shores.
So there's the domestic politics of India and the sensitivity there, and then the leakage over into Canada. And then we zoom out, and there are the far bigger geopolitical consequences of this, which I find really fascinating. What are the ramifications, Roz, for the US and other key allies who have, of course, been trying to court India?
Well, it's all extremely awkward, you'd have to say, for allies, including the US and the G7 nations, potentially including the UK, because there has been this effort that you've noted to sort of draw India much more into their orbit, economically, also strategically, as part of an effort to sort of shift the world away from China. And they see India as a real key part of that process. And so you're seeing efforts to have closer economic and trade ties with India, strategic ties with India. That's seen perhaps the allies be, they're quite careful about calling India out, for example, for the fact that India has not overtly criticized Russia for its invasion of Ukraine. That's been slightly overlooked where it hasn't been with other countries. Of course, as criticism comes of the Indian Prime Minister Narendra Modi and some of his actions at home, his crackdown on human rights, that is something also that's been carefully addressed, you'd have to say, by countries, including the US. So then how does this fit into that? How are they going to sort of navigate this question of the allegations being made against India with the reality that they really need to keep India in the tent on a bunch of key issues globally at the moment, and they want that relationship to be preserved. So you're seeing very cautious initial language from the US. You're seeing very cautious initial language from the UK and other countries, very much saying, well, we're concerned by what may have happened here, not overtly calling India out, but certainly very much not wanting this to spiral into a broader geopolitical issue.
Ross, how is this resonating inside India itself?
What's interesting to see, of course, the India media, the state and the sort of media that sort of supports Modi and his agenda has been quite strong about this already. Of course, the idea of accusing India, the state, of involvement in state-backed murder in another country. So you're seeing a lot of reaction in the Indian media on that. You're seeing the India opposition being quite quiet about it in turn, because they know that this is an issue that's going to play quite well potentially for Narendra Modi in India coming into an election cycle. Of course, he's been sort of looking at touting his credentials as a global leader, putting India on the stage and into space recently, of course, also as the host of the G20, and also sort of like India being more robust in pushing back against criticism of it by other nations. So this actually could be something that Modi can use to maximize his support at home. So you're seeing the media quite strongly supporting India so far on this, pushing back against Canada on it, and the opposition being extremely quiet.
Okay, Ros Matheson with the details and the context on what is a really important geopolitical story, the ramifications around US-China relations as a result of some of these frictions percolating between India and Canada. Thank you for the context. Coming up, the Fed is expected to pause its rate hikes today for the second time this year. We look ahead to that decision next. And later, Cathie Wood's ARC makes its biggest push into Europe yet with a big bet on the region's nascent market for trend-driven investing. We're going to speak to her about that and more at 12:40 London time. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back. It is a major week, of course, for central banks with the Fed's latest rate decision due 7 p.m. London time. The FOMC is expected to pause while leaving the door open for another increase as early as November. Let's get more then from Ven Ram from our MLive team. Ven, you've been spot on a number of occasions in terms of calling the next steps for the FOMC, and you've been looking at the dot plot projections and what you expect, the pushback maybe on cuts being priced into these markets or by these markets for 2024.
Thank you, Tom. I think that, the Fed kind of indicated 1 percentage points of policy loosening in 2024 in the June dot plot. This time around, I think they will take back some of that loosening that's priced in, because they will probably, my inclination is that they will concede 3 rate cuts, meaning 75 basis points of cuts that they will indicate for 2024. Why do I say that? 2 factors. One is that inflation has been a lot stickier than they would expect. They expect PCE below 4%, and it's still above 4%. On the other hand, they expect inflation to be above 4%, but it is well below 4%. So they want the 2 things to invert, the inflation rate to come below 4% and the employment rate to go above 4%. And until that happens, the Fed is unlikely to say that there is lots of loosening in the pipeline. So that's the thinking.
What really stands out to me is the top line. I know this isn't your consensus view, or you don't land on this as the default assumption, but the 50 basis points, they could push back from 100 basis points of cuts that are currently flagged by the June dot plots next year to 50 basis points. And that would be quite the hawkish tilt then. The market reaction to that would be significant, no?
Absolutely. I mean, if they do that, that'll be extremely hawkish. I don't expect them to do, but if they did that, that would send 10-year yields soaring. That would send the 2-year yield soaring past 522, which is the key fair value that I've indicated in my writing before. So I think that will be a pretty vehement reaction from the markets that we should expect, should they indicate only 50 basis points of cuts in 2024.
Okay, still a bit of an outlier view from Venram. The view from Venram is that 75 basis points is more likely in terms of the cuts that are flagged by those dot plots for 2024, coming down from 100 basis points. As we look ahead to that FOMC decision, the analysis there, of course, from Venram. Thank you. That is it for markets today. You can get insights from us and the team on the front page of the Bloomberg UK website, or by typing T-Live Go on the terminal. The pulse is up next. Across European equities, you're seeing gains of 0.3%, led by real estate, up 1%. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London in for Francine Lacqua. Here's what's coming up on today's program. The pound falling as the UK's unexpected drop in inflation opens the prospect of a pause from the Bank of England tomorrow. Meanwhile, stateside, the Fed expected to take a breather on hikes for the second time this year, while leaving the door open to another increase as early as November. Plus, Europe's car sales jump. Brussels starts probing China's EV subsidies. More from our interview with European Commission President Ursula von der Leyen. That coming up on the program and more. Let's start with a quick look at where European markets are trading here, because again, we are in wait-and-see mode, just looking broadly at what the Federal Reserve is going to say, the BOE, and then of course the BOJ. Not to mention the slew of other central bank decisions that we get later on in the week as well. But starting off right now, I want to say a little bit of caution. No real momentum, no real green on the screen, but enough to perhaps keep people a little bit optimistic. So you are seeing the outperformer right now, I believe, is the IBEX, if I can see that far. Of course, the FTSE 100 not far behind it. What's important to keep in mind is that the FTSE 100 has been on the back foot for the past few sessions. So to see a little bit of a recovery there, not all that surprising, especially in light of the UK CPI data we just got. We'll dive into that in just a moment. On people's minds, though, is going to be the oil story, top of mind, if I will. This chart is really interesting. Brent time spreads starting to see your biggest backwardation level since going back to November. Basically, for the non-nerds out there, what this tells you is that there's a major supply crunch, that physical tightness really manifesting in the markets, which is why a firm like Goldman Sachs, which by the way has been very bullish on the commodity cycle, can say in 12 months' time, we will still be seeing $100. That's at least the call from the firm as of this morning. That's going to have a real read-through into what the Bank of England says, specifically when it comes to the inflationary story. Remember, we are seeing a drop in inflation. We can talk about this too, because you see it in the luxury space as well. Simply that inflation is coming down, but not far enough, and any increase is coming from the fuel sector. The ripple effects here is how are goods really going to be pricing that in if you start to see things, again, get more expensive. That's going to be a topic from around the world, not just the BOE and the Federal Reserve, which maybe Jay Powell mentioned today, but also the BOJ, which is perhaps why you're seeing a little bit more hawkishness when it comes to betting that Ueda just might change his tone. Yen swaps now really signaling the higher rates, people really leaning in to that market narrative. But let's bring it back to the Federal Reserve, because as the one central bank that's reporting today could be setting the tone for the banks in the rest of the week. It is Fed Day. Happy Fed Day to everyone who celebrates. The FOMC expecting to pause while leaving the door open for another increase as early as November. This, of course, comes as the recent oil price rally feeds into fears about inflation. So what better time than right now to nerd out with two of the best. Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management, joins me right here on set, as well as a favorite, Bloomberg Opinions, Marcus Ashworth as well. We had to beg him to come on. Beg him. We had to bribe him too. And we just wouldn't take no for an answer, would we? Kim, I'm going to start with you though, because we didn't have to beg you. You get brownie points for that. Let's start there with the Federal Reserve here. They're pausing. What kind of tone does that set for central banks around the world, given that it's kind of a new concept to just pause and stay?
Yeah, so I think the big news that's going to come tonight is really from the Fed's dot plot, right? Are they going to still show that 100 basis points of cuts now that they're near the end of the cycle? We do think they will. I think how they look at how restrictive monetary policy is now is at the real effective Fed funds rate, so the inflation adjusted rate. So I think even though we're going to see their growth forecast move up, then pause at this meeting, I think what's going to be interesting is that 2024 cuts. Are they going? There's some expectation that a cut's going to be removed from there, which I think the market will take on board a bit more with a bit higher yields maybe. But we think, the federal funds rate is going to stay where it is for a while. Headline inflation expectations are going to fall. So the Fed's going to be looking at that rate and becoming increasingly restrictive in real terms over time, and just leave that steady for now.
Well, it's an easier thing for the Fed to map out, for example, because if you look at the BOJ, on the other hand, Wall Street very divergent on what those estimates look like into 2024. A little bit more consensus in the U.S. space, but I'm wondering how that translates to the markets. Marcus, this is your area of expertise. What do yields do after 2 p.m. New York time today?
I think they drop. I think that the market is really primed for a surprise and will take something which is dovish quite strongly. The market sold off relentlessly the last few weeks. It's pushing higher and higher and higher. Yes, there's an awful lot of supply, but that dynamic will get priced in eventually and fully. So we do get something akin to what Kim is saying. I think the market probably will take it quite well. I think that most of the bearishness is very much fully priced in.
Well, you mentioned the supply that they're still digesting at the moment. How much of a liquidity problem do treasuries have right now?
Well, they never have, they aren't the most liquid market in the world. So, yeah, there's no doubt about it. We have potential, foreign central bank selling, which has been going on for quite some while. We've clearly got much more supply coming from the US Treasury. The whole thing together, but that is, I think it's been fully priced in pretty much now. I think it would have to be something very bearish to push the market higher in yields, and I think that's a dynamic which I think will be across all bond markets.
Well, I think what's interesting is, to your point of across all bond markets, is that every bond market is dealing with a liquidity issue. To your point, Kim, hop in here, because when I think liquidity issue, my immediate instinct is maybe that's a market people don't want to touch. As a macro tourist investor, maybe you don't want to touch a market that isn't as easy to get in and out of. Which market? Let's go around the world. Treasuries, gilts, boons, JGBs, pick your country, if you will, has the biggest liquidity issue right now?
I think it's got to be the UK. And I think that's because we're still recovering from a big volatile period. If you look at valuation at risk models, that volatile period is still in. So just to have the same amount of tracking error in global government portfolios, you're going to be running smaller sizes. Data has also been incredibly volatile. We've seen inflation this morning, big downside surprise. So I think the volatility in the data, plus persistence in UK inflation, and plus that period is it's making that market a bit harder to trade. Not that we're staying away from it.
Yeah. Do you agree?
Partly. I think I'd always say JGBs, Japan, because there is no liquidity there at all. Well, that's because it's a totally rigged market. But there are a couple of dynamics in the UK which Kim's right to sort of point to, I guess. One is particularly quantitative tightening, active sales. Because tomorrow we find out not whether or not the Bank of England does decide to do its last, I think will be its last rate hike, but at the same time whether they increase their active sales along with a natural rise in passive sales over the next year from say 40 to 60 billion. Do they also do something similar with the active sales? I sincerely hope they don't. I hope they stop selling very long dated gilts. It's madness. But nonetheless, if they do go ahead and do it and they flag they'll make the decision, that would make liquidity in gilts, which is already patchy, much worse.
The Ashworth hot take on QT, if you will. But it's interesting that you mentioned that, because I think the strategy is really interesting here. We talk about the Federal Reserve and Jay Powell being the central banker to the world. Is this the moment where Andrew Bailey is setting the tone, perhaps, in tackling QT as actively selling bond markets as opposed to just rolling them off the balance sheet? How much disruption does that create?
Well, David Ramsden's the guy who's really been in charge of this, and I sincerely hope it's not Bailey's style to be setting the charge or anything. I hope they just go along with maybe a very modest increase, and I think really what the Bank of England are trying to do is hide, actually, and get away from. They'll do one last rate hike, a bit like the ECB did last week, and from that they're going to essentially hide behind the Fed. As long as the Fed pauses, the Bank of England probably can put this last rate hike in 5.5% and call an end to it, and hope that they can get away with the economy not collapsing into recession, which it still very well might do.
Kim, weigh in here, because Marcus is very, I don't want to say anti-Bailey, but he's gonna give a little.
Love the man.
I know he's gonna give Bailey a little bit of a hard time. It feels like, as a natural critic should. Talk to us though about anything perhaps the Fed, the ECB by extension, can really learn from the BOE, because I have to say, it feels like from a structural point of view, the BOE has it right in terms of tackling the inflation story far more aggressively. They were the first to come out there, again, preceding even the Federal Reserve. What are the lessons that Bailey can teach everyone else?
So I think you're right. They started the hiking cycle, much sooner than other central banks. They started at a good time. I do agree, however, that at some point they did get a bit behind the curve and a little bit more complacent than other central banks did. And I think that's why we're stuck with slightly more persistent inflation, especially when you look at wages and with a tight labor market. So there are things to learn. I think starting early is important, but yeah, looking ahead to the Bank of England decision next week, it's definitely much more finely balanced now after this morning's inflation print.
Yeah, around the world in 8 minutes for central bank policy. Kim Crawford staying with us. We do, however, say goodbye to Bloomberg Opinion's Marcus Ashworth. We thank you, as always, both for joining us. Coming up on the program, UK inflation for August falling unexpectedly. We're going to bring you the latest for what this means for the BOE tomorrow. That coming up next. This is Bloomberg.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome back to The Pulse. I'm Kriti Gupta in for Francine Lacqua. The UK inflation rate unexpectedly fell despite a surge in fuel prices, easing pressure for further rate hikes from the BOE. Let's bring back Kim Crawford, Global Rates Portfolio Manager over at JP Morgan Asset Management, joining me right here on set. Anna Andrade as well, one of our star economists from Bloomberg Economics as well, joining us on the Bank of England. Kim, I want to come back to you because we just spoke to you and Marcus Ashworth about, again, the liquidity of the markets around the world. We talked about the Fed, we talked about the ECB as well, arguably the JGBs. Talk to us about the market plumbing in the gilts market right now.
Yes, so I think one thing, as Marcus mentioned earlier, we're going to get a decision on quantitative tightening. I do think that they are going to increase their active sales and the pace of active sales. I think redemptions are going to rise, active sales stay the same, so the total QT bucket doesn't increase. But I think Renston has given us enough of a heads up with it, with his speech that we saw a few months ago. And I think what matters more for the plumbing for the gilt market ultimately is how fast is inflation going to fall, how weak is growth going to be, because that will create demand for UK government bonds again.
So active bond sales, it feels like we've waited a while for people to say, we got to ramp this process back up. Anna, walk us through that story. How much disruption do you think actively selling bonds on the open market is really going to create, or is this something that's kind of we've been here?
Hi, good morning. So what I would say is that the thing about QT is that it hasn't been conducted at this size. There's no precedent for it, essentially. The BOE's line has been that, a gradual pace of QT has little impact in yield, so it kind of assumes that an 80 billion envelope leads to a 10 basis points increase in 10-year yields. And so I think that's kind of, manageable, and that's why it thinks it can do more, because there was kind of a rather successful experience so far. But, we kind of wrote a note where we said, if there's reasons to think that QT has a less impact than QE, because QE was done at times of high market disruption, and it was kind of the surprise part of it that kind of really eased financial conditions. And unlike that, QT is being done in a gradual and predictable manner. So I think there's enough reasons to believe that it shouldn't be too disruptive for the gilt market. Yeah.
On the surface, that all sounds great, but talk to me a little bit about the logic behind this, because it feels like the Bank of England, and we talked about this a moment ago with Kim and Marcus, is simply that they were far out ahead of starting the QT process, but also their rate hikes broadly. They've also arguably been the least successful in terms of their peers in tackling the inflation story. Is this move towards accelerating QT and doing it in a frankly more aggressive manner their way of kind of hitting fast forward on the effects they're hoping to see?
I wouldn't say so. So I think the BOE has been most aggressive in QT. I think one reason for that is that, generally speaking, gilts have kind of a longer maturity than other European peers. So that's kind of why the BOE maybe needs to be a bit more aggressive to kind of unwind its balance sheet. But I would still say that the BOE has been very clear that it wants rate increases, or like the interest rate, to be its marginal tool, and that it doesn't want to signal anything, on monetary policy from a QT. So I don't think the QT is really responding to the surprise, to the big inflation problem that we have. Actually, interest rates are doing the work, and that's why they've come so far and so high.
So interest rates are doing what they're supposed to do. You've got QT getting accelerated. You've got inflation coming down, some good jobs data. Kim, what could go wrong?
What can go wrong? I think if the Bank of England pauses at this meeting, it could go a bit wrong. I think the decision is much more finely balanced now, granted, given the big drop in services inflation, or rather a downside beat to forecasts. But I think the problem is if they get too much confidence from that right now, while they're still staring down the barrel of 8% private sector wage growth. So yes, services inflation is coming in lower than their forecast. The labor market is loosening quicker, but we need to get more confidence that that is going to feed through to wages. So I think they do have to give us a 25 basis point hike tomorrow and accompany that with more dovish language.
Well, central bankers famously say, look, we're dealing with very blunt tools here. Especially, I feel like it gets even blunter when you talk about wages and when we talk about oil. And that's not specific to the Bank of England. You're seeing that with the Federal Reserve and arguably the ECB as well. How does fiscal policy affect or can affect the wage story?
Yes, so fiscal policy, I think at this point when wages are high and your labor market is loosening but is still tight, if you have high energy prices and you come in with fiscal policy to try to ease the impact that it's going to have on consumers, that will just create more inflation problems, which is not what we need right now. So I think fiscal policy has to stay quiet. I think we saw, for example, in Mexico, which was an interesting story, where inflation did start coming down, but the new government decided to have more fiscal policy come in, and then you saw much higher yields there. So I think fiscal policy has to stay quiet for now. Monetary policy and interest rate rises are the main thing.
Yeah. Well, I just moved to London from New York, and part of the move was navigating the housing market. Mm-hmm. And some might say this is the worst time to move to London because of the housing market and how challenging it really is. So if I had a phone call to make to Rishi Sunak or Jeremy Hunt, I know exactly what I would be telling them to do. But Anna, what would you tell them to do? What is the fiscal approach to helping Andrew Bailey at the BOE fight inflation?
I think it's exactly what's been said. It's a tight fiscal stance is what you need right now. I mean, the experience of the past year, or of the winter at least, it's been that, the government was supportive and it supported households with the cost of living crisis and with the energy price increases. And that kind of contributed to, a more resilient economy. We now know that that kind of resilience in the economy actually supported all these second round effects that we're seeing on inflation. So actually, fiscal policy for the time being needs to, be tight so that the BOE kind of achieves its goal of bringing down inflation.
Gold star for the UK government. You don't hear that very often, do you? Kim Crawford, Global Rates Portfolio Manager over at JP Morgan Asset Management, and Anna Andrade from Bloomberg Economics. Thank you both for joining the program. Coming up, NATO Chief Hans Stoltenberg says he's confident the U.S. will continue to support Ukraine in its fight against Russia. We'll bring you more from our interview next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I'm confident that the United States, as all the NATO allies, will continue to support Ukraine because it will be a tragedy for the Ukrainians if President Putin wins in Ukraine, but it will also be dangerous for us. We will be more vulnerable because then the message to him, but also to China, is that when they use military force, when they violate international law, when they invade another country, they get what they want, and that will make us more vulnerable. So it's in our security interest to support Ukraine. And therefore, I'm confident that the United States will continue to support Ukraine.
It's not just in the U.S. There is this feeling of war fatigue. Obviously, this would be easier if there was almost a timeline when American individuals and American taxpayers knew there is an end to this. What are you seeing on the ground in terms of the counteroffensive?
So first of all, what we have seen is that the support we provide to Ukraine is making a huge difference. That's the best proof that actually the weapons we are delivering actually reaches the front lines, because we have to remember where we started. At the beginning of this war, many believed, and many of us also believed, that Ukraine would fall within weeks and Kiev will fall within days. We have seen the opposite. The Ukrainians have been able to liberate the north around Kiev, the east around Kharkiv, and then the south around Kherson. And now they are...
At the moment, do you think they're winning?
Well, they are. They are now conducting an offensive. They are gradually gaining ground. We would like to see that go faster. But of course, they are faced with dug-in Russian defensive lines, enormous amounts of mines, and that takes time. But the alternative, not to support them, which will be much more costly for us in the long run, because then we will be more vulnerable for Russian or Chinese coercion and military threats. And therefore, we have to ensure that President Putin loses in Ukraine.
Is there more pressure to strike a peace agreement?
It's for Ukrainians to decide when the time is right to, and when the conditions are right to sit down. So far, there are no indications that Russia wants to sit down and negotiate a just and lasting peace. So if we want peace, if we want a negotiated outcome, the best way of achieving that is to strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield, but has to sit down and negotiate a lasting peace.
NATO chief Jens Stoltenberg there speaking to Bloomberg's Anne-Marie Hordern about support for Ukraine. Now, New York seems to be the hotspot lately. We have a lot of guests and, of course, coverage coming out of the UN right now. A lot of coverage as well in the IPO market. Instacart, for example, down 4.7% after racking up about a 12% trading debut gain in one of the year's biggest initial public offerings. Now, this is really important, folks, because as we talk about a lot of these IPOs, notice that they are in the tech space. And one of the concerns going into this has simply been, do you start to see this massive rally at the start of their debut, only to have it paired and you really go negative in the months that follow? It's been a pattern you saw for Airbnb, for DoorDash, and among other corporate names as well. Does it then extend to non-tech focused IPOs? That's going to be the question moving forward. Right now, Instacart down 4.7% in the pre-market. Coming up on the program, we go right back to the geopolitics. EU-China trade tensions increase. Commission President Ursula von der Leyen says massive Chinese subsidies for EVs warrant an investigation. That story next. This is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Falls as the UK's unexpected drop in inflation opens the prospect of a pause for the Bank of England tomorrow. Stateside, the Fed is expected to take a breather on hikes for the second time this year, while leaving the door open to another increase as early as November. Plus, Europe's car sales jump as Brussels starts probing China's EV subsidies. More from our interview with European Commission President Ursula von der Leyen in just a moment. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. We are getting some headlines here from the energy space, if you will. Total Energies to invest $300 million in JV with Adani's Green unit. It looks like Adani Green says Total will hold about 50% with the company remaining in JV's name. What's interesting here is simply that you are starting to see that diversification from a lot of these big oil companies around the world into the green space. And it's also interesting that there is appetite to do that through the Adani empire, which of course we know a couple of months ago was not as much in favor. Right now, both stocks down by, we'll call it 1% or upwards of 1% for Adani, about 2% for Total Energies. Sticking with the broader macro space, European Commission President Ursula von der Leyen has told Bloomberg the EU needs to investigate China's massive subsidies for EVs. She spoke to Francine Lacqua.
We like competition, but it has to be a fair competition. And we want a level playing field for our companies. And what we see is massive subsidies in the EV sector in China, which is, of course, unleveling our playing field. And we do not accept this in the internal market for our companies. So we do also not accept it for Chinese companies. And therefore, there is the investigation now into subsidies in EVs in China.
Have you, since actually announcing the investigation, talked to Chinese officials?
Yes, we are, of course, in constant contact. The executive vice president will travel to China and discuss it also with the Chinese. But we have now to look at the figures, and we're moving on.
In the past, there was always a tit for tat, some kind of retaliation, or certainly China making noise back. Will that happen?
Well, this we'll see, but important is that for us it's very clear we want competition. We want competition on quality, cost effectiveness, but not on subsidies. And therefore, this is something, as I said, we would not tolerate for our own companies within the single market. So it has to be fair play.
European Commission President Ursula von der Leyen there speaking to our very own Francine Lacqua. Meanwhile, fresh data this morning shows August car sales in Europe surged by 21% year on year. EVs driving a lot of that growth in new car registrations. This is the European Commission seeks to launch an investigation into Chinese EV subsidies. Bloomberg's Oliver Crook joins us now for more on the story. Ollie, let's start with the data there. What did we learn? What do we know?
Right, Kriti, this is another monster print for European car sales, up, as you say, 21%, and really just capping what has been a 13-month run of just really, really strong sales here in Europe. The concern is, however, that the back half of the year may not be quite as rosy. You have sort of the consumer maybe weakening a little bit. They've worked through a lot of the demand that they've had in the backlog, and also you're going to get a tougher comparison year on year because the back end of 2022 is when things started to really pick up for the sales, so less flattering comparison. When you look at the EVs, things get kind of interesting. EV sales in Europe doubled in the month of August. They also accounted for more than 20% of all the cars that were sold in Europe in August, which is the first time that that's happened. And they've also overtaken diesel sales by quite a margin. But what's interesting is with all of these fears around Chinese EVs, they only hold about 5.6% of the European EV market. If you want to talk about some interesting numbers, look at Tesla's numbers this year. Sales are up 145%. In the month of August, Tesla sales were up 250%. And when you look at market share, the Tesla Model Y was not only the best-selling EV in Europe for the first half of the year, it was the best-selling car, and it commands 13% of all of the EV market here in Europe, which is more than all of the Chinese combined times 2.
Well, at its core, though, it's a story of competition. At the end of the day, China, the leader in electrification worldwide, I suppose it only makes sense that the EU wants their fair share. Something that gets in the way of that, though, is going to be margins. It's going to be wages, which brings us to our next story. United Auto Workers making a truly international, I want to say, debut on their stage. They're having pretty wide ripple effects. What do we know about the latest in the U.S. and Canada?
Completely. Everyone is watching this very, very closely. And where we are is that basically there has been no concrete motion forward. We know that we have a deadline from the union, Friday noon. They need a substantive offer by then. Otherwise, they're going to expand the strike. We don't know if that means slightly or that means bringing the big three to paralysis. All of the options are on the table. That has been their strategy from the beginning. In terms of how this is actually affecting the auto players, Stellantis says they're fairly well insulated. They have taken action to sort of get inventory to offset what they're losing. However, some dealers are saying they're starting starting to see inventory come down, and S&P Global Mobility says that this is costing the big three about 3,000 cars a day in terms of production. The White House team has not yet arrived in Detroit. We know that we were expecting that sometime this week to help facilitate the talks. And really, though you have stalemate in the U.S., you do have some breakthroughs over in Canada. You mentioned that Ford and the union there managed to reach an agreement. The contracts expired on Monday night. They have a tentative agreement. That means that 5,600 workers will not strike, so at least some dialogue going on between the big companies and the unions.
Well, they do say that Canadians are more friendly than Americans. Bloomberg's Oliver Crook all over that story.
They do.
We thank you, as always. We're American, we can say that. Let's bring you some corporate news now. Stick with that theme. Amazon planning to hire 250,000 logistics workers ahead of the holiday shopping season, a jump from last year's quota. The online retail giant will also boost average pay for logistics workers amid a U.S. labor shortage. The announcement comes even as some analysts expect overall holiday hiring to stay muted. Sticking with tech, I guess we can call it, Disney shares falling after it said it plans to nearly double its investment in its parks and resorts division to $60 billion over the next 10 years. The world's largest theme park operator says it has over 1,000 acres of land that it could develop and cited increased profits in recent years from investments in rides, cruise ships, as well as other attractions. Disney says it's seen record growth in customer spending at parks over the past 2 years. Coming up on the show, we go from the corporate space back to geopolitics. In the conversation in New York, Poland's president talks to Bloomberg about the intensifying dispute over grain that's shaken his previously strong relationship with Ukraine. That conversation next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
Conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Russia's invasion of Ukraine and the perils of climate change dominated early remarks at the UN General Assembly's annual debate. President Joe Biden has urged world leaders to continue backing Ukraine, even as the country and its allies brace for the prospect of a long-term conflict.
Russia believes that the world will grow weary and allow it to brutalize Ukraine without consequence. If you allow Ukraine to be carved up, is the independence of any nation secure? I'd respectfully suggest the answer is no. We have to stand up to this naked aggression today and deter other would-be aggressors tomorrow.
Meanwhile, the Ukrainian president has told the General Assembly that Russia is committing genocide in his country. Volodymyr Zelensky says Moscow is weaponizing food and energy. Earlier this year, Russian forces attacked a nuclear plant in Ukraine and more recently moved to restrict Black Sea grain imports.
Russia is launching the food prices as weapons. The impact spans from the Atlantic coast of Africa to the Southeast Asia. And this is the threat scale. And I would like to thank those leaders who supported our Black Sea Grain Initiative and program Grain from Ukraine.
Now, Poland's president says his country will protect its market from the influx of grain from Ukraine. Andrzej Duda has also urged Ukraine to refrain from public attacks in a dispute over grain that's shaken ties between the key allies. He spoke with Bloomberg's Anne-Marie Hordern.
We have sacrificed a lot. We have given a lot in order to help Ukraine, and we want to assist Ukraine because we understand what it means to be placed under Russian aggression. But we also need to protect our citizens.
Polish President Andrzej Duda there speaking about the conflict in Eastern Europe. Let's bring in Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Will, a lot to digest in the commodity complex here. I want to start with the grain story because it feels like after this idea that Ukrainian exports of grain, the world basket or the grain basket of the world, after it started being attacked by Russia in the ports, the grain deal eliminated basically, brokered by Turkey, it's something that's priced into the grain market. To what extent is that true?
The grain prices continue to slide. They had a blip up when those attacks first happened and the grain deal fell apart. But they have been sliding and they are pretty low and certainly much, much lower than they were after the war started. Now, that's a problem in several respects for Ukraine. Ukraine has, in fact, had a very, very good harvest, and harvests generally have been good around the world. But Ukraine's problem, obviously, is getting that to market. Now, those Danube ports, which Russia is attacking, is one way, but the other way has been through Eastern Europe, and that's where the tension with Poland arises. The farming community in Poland is a very important constituency for the governing party facing elections, and those Ukrainian grain exports through Eastern Europe are depressing prices. So there's a real source of tension there.
And building, by the way, should we say, decades of tension between Poland and Ukraine as well, only united via the conflict with Russia. Talk to us a little bit about the ripple effects there. If you start to see this kind of weakness in soft commodities, how long does that last?
Well, if we think about Russia, of course, is the world's biggest grain exporter. It is looking like have a very, very healthy harvest again this year and export record amounts of grain. So Russia is benefiting hugely from this. Prices aren't great, but its exports are rising as Ukraine's exports fall. So it is doing okay, whereas Ukraine is finding it very hard to export grain and then not getting great prices when it does so. So for Russia, they're able to exert this pressure on Ukraine by ripping up the grain deal, by bombing its grain export ports, but benefit itself and, importantly, not antagonize its allies in the southern hemisphere because grain prices are affordable for most buyers right now.
Where does that grain go exactly? Because, of course, we know they're competing with the United States as well in terms of harvests. Is this the grain that goes to Asia?
Most of the biggest buyers of Russian grain historically are in the Middle East. Egypt is the world's biggest grain buyer. Other Middle East nations buy a lot of wheat, but Africa and to Asia as well.
Yeah, the bread belt of northern Africa. Of course, we know that was a big part of the Arab Spring, I believe, several years before. Let's switch over to oil, though, because that, of course, is a connected story. What is driving oil prices right now? Where's the tightness coming from? Is this purely the Saudis?
It's It's definitely led by the OPEC Plus coalition. Saudi Arabia has made big cuts, that 1 million barrel a day voluntary cut. Russia has made some modest cuts to its exports, and importantly, they've extended that to the end of the year. And coming against what is a demand picture which is much more buoyant than people might have predicted a few months ago, those restrictions to the end of the year, restricted supply, strong demand, and you've got the price rally that we see.
How much pushback do you think the OPEC Plus members are actually going to get, given that originally I think, justification for originally doing this was to bring back their break-even prices back to a level where their national budgets weren't in deficit anymore. Now we've gone way past that point. Even Goldman Sachs talking about in 12 months a $100 price target on Brent. Where does the pushback come from?
Well, if we look at it from the perspective of OPEC Plus, I think they feel that this is a fair price because their dollars are not worth what they are today, what they were a few years ago. They're grappling with a world in which the things they're importing are more expensive, and they feel that they need a higher price, and it's fair that they have a higher price to maintain their purchasing power. That's the first thing to say. Where the pushback comes from is an interesting question. Obviously, $100 tends to be a pain point for people, or an obvious point for people to focus on. And on top of that, you've got a very stretched oil refining system around the world, which means fuel prices have risen further still. So we are starting to see those prices feed through to consumers, and for that it could cause discontent in major consuming countries, in Europe, in the United States, in Asia. So the equation for OPEC Plus is how far they feel able to push it. At what point does it, A, start to make things too difficult for them in their relationships with their allies, and B, that they may see some demand destruction. And I think that's what the market will be seeking to find out in the weeks ahead.
Plus, of course, the bottlenecks in the refined product space, which you alluded to as well. A fascinating time to be Executive Editor of Energy and Commodities. Will Kennedy, we thank you as always for joining the program. Let's go back to the UK now. Rishi Sunak facing a backlash among conservative MPs after the British Prime Minister said he would roll back some of the green energy policies, all while continuing with the country's 2050 net zero target. It's thought Sunak could defer a ban on new diesel and petrol cars by 5 years to 2035, but the government hasn't yet made that decision public. Opposition parties are also trying to capitalize on the government's environmental policies. Speaking with Bloomberg TV's Francine Lacqua in New York, London Mayor Sadiq Khan says the Prime Minister is proving weak on the climate crisis.
The response of governments should be actually to turn this awful crisis into an opportunity, creating green jobs, a Green New Deal, thinking about how we can both save the planet, address climate change, but also give people security and have that just transition. And this is basically, lazy politics from a weak Prime Minister throwing red meat to his backbenchers because he's so weak and ineffectual.
Mayor of London, Sadiq Khan, there speaking to Bloomberg in New York. Now, coming up on the program, we preview the Fed's rate decision today and whether Jay Powell will leave the door ajar to further rate hikes in the battle to tame inflation. That conversation next. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Wall Street is waking up. Europe is already trading. And Manus Granny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
What's the biggest transformation happening in beauty is what we call beauty tech, is the help of technology to augment the performance of beauty products, either through diagnosis or through even personalized made-to-measure beauty products. And that's probably the future of beauty. Indeed, we use AI. We use AI to augment our researchers, to invent new ways to formulate products, to go faster. We use AI to indeed to provide the best advice to consumers.
Color matching.
Color matching, skincare. Skincare diagnosis is very important. In the end, consumers are passionate about beauty. Beauty is the #1 topic of conversation on TikTok, for example. It's something that passions people, but it's a jungle out there. There's so many products, so you need to help people choose. So curation is a very important part, and to help people make the right choices, you need some sort of either diagnosis or virtual try-on so that they see which shades are going to fit better. Same for hair. So technology is a great help, not only to create new products, but also to make consumers happier about the products.
You can, of course, watch the full interview with leaders with L'Aqua Goes Green, airing at 9:30 p.m. New York time tonight in the U.S., and then at 6:30 p.m. London time on Thursday. Now back to our top story. It's a major week for central banks with the Fed's latest rate decision due at 7 p.m. London time. The FOMC largely expected to pause, perhaps leaving the door open for another increase as early as November. Let me just take a moment to emphasize just how big the consensus is here. The big number I bring you, 5.5%, the percent of estimates in a Bloomberg survey predicting a rate move by the Fed, which tells you everybody is in the camp of saying they're going to pause this time around. Let's see if there's any surprises. Who better to ask than Bloomberg's Valerie Teitel joining me right here for a preview. Valerie, any surprises?
It's all going to be in the dot plot, frankly, Critty. Just how much higher they shift up that 2024 dot. And on the flip side, on the dovish side, do they keep that threat of an additional hike this year still in that dot plot, in that 2023 terminal rate? The consensus lately, the market discussion lately is really focused on those 2024 dots. Some say that to get a hawkish reaction from the market, it'll have to shift up higher than 25 basis points. And Critty, the slope at the moment between the dots, the 2023 dots and the 2024 dots, as you can see on the screen, does imply 100 basis points of cuts before year-end 2024. If Powell does want to give a nod to the recent economic strength, in some way allows him to cast some doubt on the downward trend of inflation, on the recent softening of the labor market, he would shift those dots higher in a bid to convince markets that there are no cuts on the horizon, that he needs to see a growth slowdown in order to trust inflation's downward trend.
I've always been a little curious about who invented the concept of a dot plot. It feels a little easy, I guess, unless you're actually doing it. Valerie, talk to us about the oil story, the wage story. Do you think Chair Powell's going to mention it today?
These are a few risks people have been talking about recently. Obviously, the upward trend of oil has caught many, many by surprise, leading us to ponder if there's going to be another resurgence in headline inflation. But I think Powell is going to take the opposite side of that view and think that this rise in oil prices is going to dent the consumer more than ignite inflation. We know that growth has started to turn. The consumer story has started to turn a bit weaker, and perhaps if they're spending more of their disposable income on filling up their gas tank, they're going to be out spending less on other things elsewhere in the consumer sphere. So that may be something Powell acknowledges. There has been a lot of doubts in the consumer lately, whether it's the student loan repayments resurging, coming back this month, or in fact, that rise in oil prices. There might be some other risks on the horizon that Powell could point to, Critty, one of them being the imminent government shutdown and the auto workers union strike.
Yeah, a lot on Chair Powell's radar. Valerie Teitel, thank you as always for walking us through that. Of course, you can see that rate decision, full coverage here, 7 p.m. UK time. I want to quickly get you some headlines that we have just crossed the Bloomberg terminal. Chevron and the Australian unions failed to reach agreement after their talks. Of course, we're watching the labor story around the world, but it looks like this certainly not going in Chevron's favor. Another major mover this morning, UniCredit, planning to start a €2.5 billion tranche of its 2023 share buyback program on the back of some pretty high capital levels and robust financial performance. Those shares higher by 3.8% already, one of the best performers this morning. Coming up next, Bloomberg Brief with Manus Cranny in New York and Danny Berger in London, setting you up for the New York trading day ahead. Stick with us. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power of the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to the Bloomberg Brief. Let's set your agenda.
It's Fed Day. The central bank is set to deliver a hawkish hold, but leave the door open for another hike. 5- and 10-year Treasury yields hit the highest levels since 2007. Meanwhile, the pound falls as the UK's unexpected drop in inflation eases the pressure on the Bank of England to hike tomorrow. And angst in the ranks. Mike Mayo says Goldman Sachs CEO isn't leaving anytime soon, despite the growing criticism of David Solomon's colleagues. Danny, good morning. We just got to focus in on the Treasury market. It's popping. It wasn't the clouds of smoke that came from Canada yesterday. It was the angst about inflation that caused a pop and roll in yields. You're looking at the highest yield since 2007. We get the dot plot today. Will the dot plot tell us 100 basis points of cuts 2024? That is the only thing the market is interested in. How hawkish or dovish tilt will the hike, will the pause possibly be? Cable getting trashed this morning. The CPI, this was the shocker, and the core CPI. So CPI at the headline comes in at the lowest level in 18 months. And this has given the sterling burrs everything that they wanted. Hugh Pill at the Bank of England talked about Table Mountain. It could be that you see some kind of a dovish pause, or maybe even one more hike and done. Sterling down this morning. You're going to have to see a disappointment from the Fed, maybe, to bolster the pound. And Brent, 92.95. What you got here is, of course, Goldman Sachs, who are one of the big bull protagonists, again calling for $100 oil. They say deficits will take shape in the third quarter. They say most of this vital commodity rally is done, but that OPEC will sustain $80 to $105 oil. So at the moment, we give a little bit back across these markets, but it is angst in the ranks in the macro picture. Good morning, Danny.
Good morning, Manus. All I can say is now that you're getting paid in dollars, if sterling keeps doing that, lunch is on you next time you come visit. Look, bad news for the pound, maybe. Bad news for my wallet, maybe. But good news is good news, at least for this UK equity market. Mid-caps having a hell of a run this morning. They're up about 1 1/3%. That's being lifted by the home builders, by some of the multinationals. If you look at the FTSE 100, benefiting from lower rates and a weaker pound. European stocks up for the first day in 3. Meanwhile, S&P 500 futures, those are up 0.2%, gaining back after some of yesterday's losses. Bank of America, the team over there, just upgrading their year-end call to 4,600. It had been 4,300, which would have implied a drop. So they've upgraded it. Savita Subramanian over there saying that the macro indicators, the positioning, all of that reading more bullish. But the equal weighted Manus will do better than the market cap weighted of the S&P 500 futures. Okay, let me quickly show you Instacart. We had that IPO yesterday. Shares priced at $30. They went up to $34. Now we're back down at $32 in the pre-market session. So yes, Manus, they're still above where they had originally priced for, but come on, it is so gutsy to try to put an IPO into this market. Not only the week of the Fed, but the BOE, the BOJ, Norges Bank. I mean, so many central banks. Not exactly an easy debut.
No, it's not. But then, of course, some would say that ARM left some rich pickings on the table last week when they floated. So it is the land of the brave, which takes us to, I mentioned the dots. What will the dots tell us today? And I'm drawn to the macro compass by Alfonso Peccatiello. I think the dot plot, I love this, is pure gaslighting. The Fed is just telling us their median reaction function, given the information that they have today. It's not a prediction, but it might still move the markets. And therein lies the point, Danny Berger, which is, do the dots matter? Do you listen to the Treasury Secretary, the former Fed chair? Do you listen to Powell? When it suits them, they matter, and when it suits them, it doesn't.
Yeah, and how much conviction will even be behind those forecasts? As Anna Wong from Bloomberg Intelligence points out, you have UAW strikes, and at the same time, a potential government shutdown. Can they really promise another hike if it's in the dots? So, Manus, okay, we are preparing for today's Fed decision, but one thing that caught us off guard, unwound some of the yield move, was that UK CPI. It unexpectedly fell to the lowest in over a year, and it does open the prospect that the BOE could pause. Let's get over to Bloomberg's Valerie Teitel, who has a breakdown of the numbers for us. Valerie.
Danny, the inflation print out of the UK today was soft across the board. The breadth of this print today was wide. It wasn't driven by one-off factors, but across the entire inflation basket. A big relief when it came to the core CPI print, falling from 6.8% to 6.2% today. And also services inflation, which has yet to show a peak in the UK, finally did so today. It fell from 7.4% previously to 6.8% today. That is a big drop in the very, very sticky component of services inflation. The market reaction so far is clear. The Bank of England might not need to hike that much more. It was only 2 weeks ago we priced 2 more hikes from the Bank of England in this cycle. We're now down to pricing just 1 more. And in fact, for tomorrow's meeting, Danny, we're now pricing a 50-50 chance of that hike. If they do go ahead and hike, the market does expect some sort of signal from Bailey that we are near the peak. Very similar mantra that Lagarde gave us last week. But after this inflation print, really the only thorn in Bailey's side is that high wage inflation, that pay growth. It is looking like inflation for now, especially core inflation, is playing ball for the Bank of England.
All right, a nice edge decision tomorrow. Valerie, thank you so much. Valerie Teitel there. Let's bring in now Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, great to see you. Thanks for coming in this morning. All right, so front end of the UK gilt curve off by about 13 basis points. Do you agree with what the market is starting to price in, that we might get a pause tomorrow from the BOE?
No, this is an absolute knee-jerk reaction. You just have to think, headline CPI, core CPI, they're more than 3 times the target level. This is not the point that the Bank of England can rest. And Valerie just said a really important point there, which is it's all about wage pressures, because the concerns are that there are secondary impacts, which means that you have inflation sustained at a higher level. This is very sticky inflation. So this is undoubtedly good news to see inflation coming down more than expected or even coming down. But I think this is far too early to say that we're at the end of the cycle. I think what it does do, though, is, of course, it does suggest that maybe they're closer to the end than maybe markets had been originally thinking. But remember, this is not just good news. The reason that inflation is coming down in the UK is also because there is an economic slowdown happening.
So they need to balance that, though. So is there a potential Trichet moment coming? We talk about it with the ECB. Does it apply to the UK that they could overdo it if they keep pursuing hikes at this point?
Well, I think the Bank of England has probably the hardest job of all the central banks at the moment because of the visible growth slowdown that we're already seeing and the fact that inflation is the highest over here of some of the G7 countries. So yes, there is a chance of overdoing it. But also, from central bank speak, the concern is always going to be about inflation becoming really entrenched. So they have got a very difficult balancing act. I would say that today it's too soon to think about a pause. But are they going to continue to hike every month, every meeting? Probably not, given the unveiling data.
Seema, good morning. Good to see you. Yeah, they don't want another existential moment of angst. But you set the table, a very salutary warning, which is don't be bluffed by this CPI print. I reflect back to what Hugh Pill had to say, which is, this was at his speech in South Africa. He wanted to try and get a Table Mountain-like situation, but he talked about fewer risks of financial stability, imposing fewer risks of financial stability. How stable, how liquid, how concerned are you that there is some angst in the UK at the moment, that we risk a policy accident?
Well, I say so the financial stability risks, I would agree, they are quite contained. We're not seeing any really visible signs of stress. The thing is that central banks always have to stay alert. As long as rates are going up, as long as we've got this bond sell-off in play globally, there is always going to be a risk. But for the Bank of England specifically, the greater concern is just about what the economic downside is. How far do they need to go in order to contain inflation without really tipping it into a deep recession, which has then sustained and permanent damage on the UK economy?
And herein lies the point. We had Nura Rabini with us just the other day, and he said the UK is going to be the worst of all stagflation scenarios. And I think off camera and on Instagram, he said, in stagflation galore. Would you go as far to call that kind of a turgid situation for the UK economy?
That is a risk. I'm not sure if I'm going to go as far as to say that's a baseline scenario. I think, at least the data that's coming out from inflation today is certainly it's encouraging. But as I said, that is a risk. It's also the risk for Europe as well, that is stagflation takes over. But, we're moving in the right direction. but you probably do need a little bit more work. And the fact, as long as stagflation is the term that is being thrown around, I think it just goes to show how cautious and careful the central banks have to be in maintaining some of that pressure that they have.
Can you touch this gilt market in the meantime? If we are going to see gut punch reactions like today, as you say, it doesn't necessarily make sense that they'll need to hike again. Can you touch the market?
It's a tough one. I think generally bond markets at the moment are very difficult to read. You know, I think we're at a turning point for a lot of central banks. You know, we kind of consider it the last mile. And typically when you're getting to that last point, equity markets, bond markets are all very volatile. It's very difficult to get a clear reading. So in a way, you have to take more of a 1 or 2 year perspective. You know, what do we think is going to be further out? And from that regard, yeah, maybe you want to have a bit of exposure to gilts, to treasuries, especially when you think that there's an economic slowdown coming. You want to have that kind of protection.
Where does the pound play into this, Seema? If you want to take a little bit of exposure, let's say, to the gilts, etc. You look at the pound. The pound has rallied by about 20%. I mean, it's off its highs from that Trussonomics debacle. Here we are. It gives a little bit back over the summer. What role does sterling play for the Bank of England? It's in that comfort zone, I would say, would be my take. Your take?
Well, I'd agree. It's in a comfort zone. I actually don't think that sterling is going to really play a big role for the Bank of England's decision-making at the moment. Having a weaker pound is obviously going to be helpful, given that we have an economic growth slowdown ahead, or even here right now. So I don't think it matters as much. I think it matters less, certainly for a lot of other central banks out there. And, you know, of course, it does add to the inflation pressures slightly, but typically the Bank of England puts a lot less emphasis on sterling than you do from the ECB or Bank of Japan, for example.
Okay, well, there's a certain level of paranoia, isn't there, at the Bank of Japan at the moment, and we'll get a little bit more on that before the end of the week. Seema, stay with us. It's great to have you in the studio this Wednesday morning. Coming up in the show later in the hour, we'll catch up with the UBS chief economist, Paul Donovan. Is he duped by the false dawn, maybe, from the CPI? We're also going to discuss the future of David Solomon, as a top bank analyst. Mike Mayo remains positive. He's not leaving anytime soon, despite the growing criticism this year, right here on Bloomberg. Good morning.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, their product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Will the Fed hold rates rates steady as expected.
The Fed trying to back into the shrubs and disappear.
They're as data dependent as we've ever seen.
And will they keep one more hike in the dot plot?
The services prices are going to be a concern.
There is this risk. Maybe inflation starts to pick up again.
Trust Bloomberg for the fastest coverage and exclusive analysis.
You could see more headwinds.
They may actually tip the economy into recession before they start cutting rates.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. The Fed certainly has started to gear up for a hawkish Fed decision today, Manus. 5s and 10s. Yields broke the highs of the cycle, if I can get my words together, yesterday. We had basically a 6 basis point move for both of those. The 2-year yield may be an exception. That did hit an intraday high, but then pulled back. Still, this market is not yet pricing in another hike from the Fed this year, firmly pricing in a pause for today. Still with us is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, PIMCO thinks that we're underestimating the risk of another Fed hike this year. Do you think we're underestimating that risk?
There is always a risk, especially when you've got oil prices moving up, right? And we know that the Fed, I think, has to be looking at the last 2 years and remembering that maybe they overlooked some of those concerns a bit too much. But generally speaking, we are expecting the economy to slow down. You know, the question around recession is a tough one, but certainly an economic slowdown. We're seeing inflation moving in the right direction, at least for now, especially on the core inflation side. So actually for us, we think it's a pause. We think that rates have peaked. But I think from the Fed's perspective, and certainly for Powell today, it's really important to maintain a bit of a hawkish message. So, you know, it serves them well to almost have that additional rate hike in the dot plot, maintain that pressure, because the last thing they want to see now is for financial conditions to start loosening, and then you reinvigorate inflation pressures.
Financial conditions are quite loose at the moment, though. Manus and I have talked about this extensively. If you look at FCON from the Bloomberg guide, it has shown it's still not really moving that far above zero. The fiscal picture comes into play with that, too. I mean, are conditions even too easy right now? Again, once you factor in the spending from the federal government?
I think it is. And, you know, with the financial conditions, a lot of it is because the credit market continues to be very healthy. Obviously, equities have done well, although petering out a little bit recently. Yes, for the Fed's perspective, they do need to have tighter financial conditions. But, you know, this is one of the balances that they have to take is, you know, they don't want to destroy the economy, but they also have to keep that very, you know, one eye very closely trained on inflation and where they want that one to go.
So, Seema, it is in theory all about the guidance from the dots. To what extent should we bank on them? I mean, I started the show by saying, Alfonso over at Macro Compass says, look, the dot plot is pure gaslighting. But the dot plot, according to the Fed, is 100 basis points of a cut the last time out in 2024, and 125 going through to 2024, and then through to 2025, 125. How much are you banking on the dot plot as a real steer for forward guidance?
We're not, and actually, I love that quote from him. Gaslighting, I think, is correct. And, you know, you just have to look back at the last couple of years and just think about what the dot plot had been indicating and then actually what they ended up doing with policy to know that it is just a forecast. It's very data dependent. But I do think that there's a bit of messaging in there from the Fed at this stage where they're trying to give us the indication that, look, there is always a threat of further rate hikes if inflation doesn't play ball. So, you know, as I said, it doesn't serve them well to suggest that we're at a pause, which could maybe reinvigorate inflation pressures. So I think it's important to watch it, but I don't know if it would necessarily change my forecast that we think that the Fed is already at its peak.
Tell me whether I'm misguided. A lot of people do on a continual basis, but if the dot plot says 225 basis points of cuts over the next 2 years, you'd have to have some kind of I don't know, you described the recession to me. It would have to be quite a sort of a brutal punch to the economy to deliver 225 basis points of cuts.
I mean, I would agree. I mean, we are actually expecting a very, very mild recession next year. So starting in Q2, lasting 2 quarters, very, very small peak to drop. The big thing is, of course, what goes on with unemployment. But even within our forecast, we're only expecting 3 rate cuts next year, so 75 basis points of cuts for next year. So for the Fed at the same time to be saying that they don't expect recession, but then maybe to continue to have in their dot plot numerous rate cuts, it is slightly at odds. So I think that's a fair point.
Does United Auto Workers strike unfolding and a potential government shutdown, how do those two things feed into your outlook?
It doesn't feed into it too much. You know, from the inflation side, I think it's actually quite small. Maybe the strikes invigorate a few more wage demands across the economy. That's something that we need to watch. The bigger concern is really on the growth side, and I think that's where the threat is. And from the Fed perspective, it's another risk out there, which to me says, don't hike any further, but then keep the eye on the oil prices and everything else. That's a reason just to stay on hold for longer. So no rate cuts until you have clear evidence maybe that the labour market is starting to move into a downturn.
Seema, you know, when you look around the world, where are we in the evolution of the wage narrative? It's been the, you know, sticky inflation has been driven by services around the world, in Europe, in the US, and even in Japan, which we go towards on Friday. It's about, will we have enough data on the wages side to shift from yield curve control? Are we missing a beat here in the higher for longer narrative? It is wages are now moving into a new paradigm. Is there a shift? Is there a global shift that we need to reprice?
That's a good question. I mean, I do actually think that is one of the key questions when you're starting to think about beyond just the next 3 months and looking out over the next couple of years. It is about wage demands. The thing is, if you look at real wages, they're only just starting to move into positive territory. Real wages, they've been negative. That's why a lot of households have continued to be pressured. So this is almost a healthy development in some ways, which is why a central bank like the Bank of Japan wants to almost maintain a little bit of that pressure, but then keeping an eye out to make sure it doesn't take off too much. For the US, I think it's a difficult situation in a way because you are starting to see a little bit of unrest, you know, feeling that households are struggling too much and therefore they require further wage demands. So it's one thing that we have to keep watching. I generally think that a lot of the negotiating power is starting to shift back away from employees back to employers. So maybe some of that wage growth is going to start fading in the next few months.
Well, certainly the back to work and back to the office narrative is driven very much by the fear of recession, by the fear of slowdown, and that's got a consequence in terms of the balance of power between employer and employee. Stay with us, more work to do. We got you up early. Let's make value with you in the House. Coming up on the show, Goldman CEO David Solomon. He's drawn criticism in the past year over lackluster earnings, but Mike Mayo believes he's safe in the role for now. We discuss what the analyst says on Wall Street.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, Manus, the coverage of Goldman CEO David Solomon has been pretty brutal. I think there was even a New York Post story at one point talking about awkward dinner parties he was throwing. But as part of the mea culpa, Goldman continues to sell off its consumer assets. Latest reporting that they're going to be selling Green Sky to a consortium, including 6th Street.
And it's part of the fixing some of the problems. And this is Mike Mayo, the analyst, famed analyst across banks in Europe and here. He says Solomon's not going anywhere anytime soon. He met the board's lead director, and their conclusion is the CEO will stay in his role for the medium term, whatever the heck medium term is, Danny. And of course, they met with Adebayo Ogunlesi, who is the lead director. Yeah, in hindsight, they should have gone quicker. They should have punched it harder on the consumer front. But it looks as if they're putting that in order now. Will we have a little bit more?
I got to say that. Yeah, that medium-term thing, just quickly say, that definitely stuck out to me. But you're right, Manus. Coming up, Seema Shah, we'll get back with her, of Principal Asset Management on Bloomberg.
Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. It's Fed Day. The central bank is set to deliver a hawkish hold to leave the door open for another hike. 5- and 10-year Treasury yields hit levels not seen since 2007. Meanwhile, the pound falls as UK's unexpected drop in inflation eases pressure from the Bank of England to hike tomorrow. And angst in the ranks. Mike Mayo says Goldman CEO isn't leaving anytime soon, despite the growing criticism from David Solomon's colleagues. All right, let's get your quick check on markets here. We have that softer than expected UK inflation. That sets off mid-cap UK equities, thanks to home builders, thanks also to the multinationals. European stocks, Manus, those are up for their first day in 3, up 0.5%. Finally, S&P 500 futures climbing back some of the losses that they have seen. We saw an upgrade from Bank of America on their year-end call. 4,600 is the new figure for them. Quickly, let's switch it up. Let me show you what Instacart is doing this morning in the pre-market for its second day of trading. It debuted at $30, went up to $34 yesterday. Now it's back down to $32. So some of the wind being taken out of those sales, Manus.
Okay, Danny. Well, of course, that is the elixir of life to every central bank. Softer CPI, it gives them that caveat, it gives them that optionality to move out, and that's what's drowning sterling this morning and the short end of the curve. But across the assets, we have oil, we have currencies, and we have Fed Day, of course. On the oil market, Goldman Sachs, they were the big bullish call of $100. They were out of the traps early. They're back in there again. Brent will make it to $100. They've raised their Brent call from $100 to from $93 to $100. Now, they say most of the rally is behind us on sterling. Don't be fooled. Seema Shah said, don't be fooled by this softer CPI print that you have at the moment. Sterling is down. The swaps market now say 25 basis points of a hike on Thursday from the Bank of England. They're trimming back their overall estimates. And then, of course, it is the beginning of Fed Day. What will the dot plot actually tell us in terms of rate cuts for 24, rate cuts for 2025? How hawkish a pause will today be? But to the CPI in the UK, the elixir of life for caveat emperor for the Bank of England. And this is the performance on the short end of the curve, Danny. As you can see, a dramatic drop in the short end, the biggest one-day drop, I think, since June of this year. Do you want to believe that you're going to see maybe table mounting created by the Bank of England, as Hugh Pill said to us in South Africa just a few weeks ago? Danny.
Yeah, Manus, and as you pointed out, Seema Shah, who we're going to get back to shortly, did say, look through this one reading. It is just one reading. It doesn't make a trend. But we know the UK has consistently surprised to the upside when it comes to CPI. So it's interesting to put it in the global context of Canada getting a hot reading tomorrow. Does this make us perhaps rethink this narrative of sticky inflation everywhere? Perhaps the UK sets the cat among the pigeons.
Look, absolutely, and there's no doubt about it. It was the angst in the ranks in the macro policy from Canada yesterday. A hotter Canadian inflation reading really set off those bond markets in the New York session. But I think really over the next 24 hours, next 36 hours, we're going to get a redefinition of what G3 looks like.
Yeah, a lot to go through over the next few days. Let's do just that. Still with us is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, we're going to switch things up a little bit. We're going to do a little bit of a rapid fire and get really into these markets. So I want to get your quick take on some of these different assets. Let's start with risk. Let's start with equities. Is now a time to be long or short American equities?
I think this is a time to be neutral because I know this is going to be too quick, but the thing is that at the moment, it's going to be very difficult to get the timing right. We think there's going to be a bit of a pullback, but it's going to be quite short and shallow. So this is probably the time to be neutral and then look to edge in as you start to see economic downturn unfold.
See, Seema, you're quick but eloquent. It's amazing. All right. Tell me then about high yield, about junk bonds, obviously very correlated. Is it the same for that market?
It is. It's similar. So you do need to have some exposure because it's too good at the moment to avoid, to not have. But at the same time, if we're expecting the economic downturn, high yield is a bit which will be impacted the most. But again, it's not going to be impacted too hard because this is still a short, shallow downturn that we're only anticipating.
So short, shallow recession. Let's talk about then the opportune moment. I think you and Bob Michael must have had either a bit of lunch or a bit of breakfast. Bob Michael wants to buy every dip. Here you are. You say the bond sell-off, any bond sell-off is an opportune moment. Where in duration do you want to be?
So actually, we're thinking about longer duration at the moment. You know, we do think the economic downturn is coming. That's going to put downward pressure on that 10-year point. At the same time, you know, you can get in a 2-year, you can get in right in the front end. But really, this is a time to lock in any of the gains that you can get from a 10-year perspective. So actually, we're thinking longer duration rather than that short end point.
Equity risk premium is at a 20-year low. So what goes through my mind is how long of equities do you want to be, or do I, and some would say, waste money and buy myself some protection, buy some VIX, which in theory is perhaps a little bit of value at the moment.
So really, VIX should be going up, but actually, I think we're having to rethink of the way that we think about volatility because it hasn't been moving in the way that we would anticipate. Equity risk premium, it is low. This is, I think, the time that fixed income is a little bit more attractive than equities, but it's fairly equally set at this point because there should be a rally once you come out of a bit of a dip in equities.
The dollar bulls and the bears have been equally shook, perhaps, this year. Those who thought that they could take positions against the dollar have been badly informed to the other way. Seema, we're going to get the BOJ later this week. Could we finally see a dollar downtrend in place?
I think you could, but it's not going to be too significant. You know, we do know that the Fed is going to be, we think, is going to be on hold for a while. So there's still that hawkish commentary starting to come out from them. So it's a bit of a downward move, but I don't think it's going to be very significant.
So I just did the big bullish call from Goldman Sachs there. They're back on this rampaging $100 oil, and that OPEC are going to keep us there. I can't pin you, well, maybe you will give me a pin down answer on oil, but you have a broader church which I'll give to you. Do you want to be long of oil? Do you want to be long of commodities? Given the depth of recession that you think we're going to have?
So look, it depends entirely on what your time horizon is. If you're thinking about the next 6 months, I would be neutral because I think reading oil prices, given it's a supply move, it's a tough one to try and make a decision. If you're looking out over a longer term perspective, you should be overweight commodities because that supply shortages is only going to keep picking up. And we think oil prices, commodity prices, upward move over the next 5 to 10 years.
When does the rubber hit the road of higher oil impacting your other asset allocation? Is it $100 a barrel, as Goldman says? Is it something else? When does the rubber hit the road?
So let's say it hits about $120 a barrel and it's maintained there. That to us is a deeper downturn than we're anticipating. And at that point, I think you want to be really heavily into risk, into safer assets and risk.
All right. Looking at China then, that's another area where our assumptions have had to be challenged. When it comes to China exposure, whether you want to do it outright or perhaps in Europe, luxury, those sorts of things, can you buy China exposed assets right now?
I think it's a really tough one. So although the central bank and policymakers are trying to do more, I don't think it's going to be enough to convince investors to be increasing their allocations at this point. We would prefer other assets within EM which have a bit of a diversification to China. So India, for example, is a really key diversifier against China. If you have any concerns, increase exposure to India.
I like the way you frame the Indian narrative relative to China. It's not the perfect hedge, but it is something that you see as a contra to China. A lot of people are debating what the PBOC does next. Lots of incremental policies, but what is it that would shift the risk dial for China for you?
So if they really come in aggressively on the property market, that is the only thing that's going to make any kind of move for the China economy. Interest rate cuts, if it's not hitting the property market, it just doesn't do enough because there is very, very subdued confidence at this point. I don't think you're going to see that bazooka move, at least for the time being, until you see maybe a deeper downturn. And at this point in time, given you're seeing that economic data is starting to bottom, I think maybe the central bank will be a little bit reassured and can sit back and rest again.
Seema, you've survived the rapid fire. I hope we don't scare you off. Please come join us again.
Absolutely not.
All right, Seema Shah there from Principal Asset Management, playing ball excellently, I might add. All right, coming up, we're going to continue the conversation ahead of a lot of central banks. UBS Chief Economist Paul Donovan joins us. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things, but maybe it'll be a little bit beyond skincare.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation.
That was the economist Noura Rubini speaking with Danny and myself on Monday. UK inflation for August unexpectedly fell to an 18-month low, easing the pressure on the Bank of England to hike tomorrow. Do they have the justification? Paul Donovan is the chief economist for UBS Global Wealth Management. Good morning, Mr. Donovan. Do they have the caveat that they need to pause, or would it be a mistake? Good morning.
Good morning. Well, the Bank of England is a very academic institution, and it has no problem with having very, very public and very, very significant internal disagreements. And I think that's what we're going to get tomorrow. We're going to get a very, very split decision. And I think it is now very, very finely poised as to whether they vote for hopefully one last hike or whether they decide to stand pats. It's not just the inflation data, it's a lot of the detail. UK inflation actually overstates what's happening with inflation in the UK. Food price inflation is actually lower than is being reported because supermarkets have this very weird dual pricing strategy. There's lots and lots of complicated factors here. So overall, if I was allowed a vote on the MPC, I would probably vote for no rate hike. I suspect the bank is probably just going to tip over into a rate hike at the decision tomorrow. But as I said, it's a very, very finely poised decision, and the bank loves to have internal disagreement.
And maybe that's the most healthy of all discourse. I like the way you talked about a British pint of lager. This is the conundrum within inflation in the United Kingdom. CPI is the most expensive pint of lager. It's 3 times the cheapest. I mean, just take me behind the pint of lager and why you're using that analogy and why it matters. And do you think the Bank of England, they're like a pint of ale at Threadneedle Street, don't they?
Yes, although the price in London is not the highest price. That's an important point to bear in mind. So, if the Bank of England governor is popping out for a pint of beer before the MPC, or possibly before the press conference, then he can get it a lot cheaper. The point here is that, firstly, there is a lot of divergence of inflation experience emerging, and the divergence has increased. That's one of the really interesting things, not just in the US. I mean, in the UK, it's also happening in the States.
Yeah.
The other thing about this, that it means that the inflation experience of some people is actually very different to the aggregate inflation experience. If you're living in the West Midlands, where a pint of beer is a little over £2, it's a far different experience to East Anglia, where it's over £6.50. So very, very different experience, and that means the spending power of consumers in different parts of the economy is noticeably different as well. Now, this, I think, is a bigger deal in the States. One could argue that the US doesn't have an inflation problem. It's got a Florida problem, because Florida is where the inflation's at. Lots of other parts of the States, inflation is back to within pre-pandemic ranges.
Manus, come on, you're in the U.S. now. Do you need to avoid Florida? I think New York, come on, New York's got to be worse than Florida. Manus, how much do you feel it moving from Dubai there?
I feel food inflation here because I'm not cooking at the moment. And as for rent inflation, I mean, the broker that I've got, he's a little bit wealthier. The two brokers that I've got, they split the rent. But Paul, you know, inflation here is live. It is kicking. How does it, you know, there's the point. It really, I can really feel inflation coming into this country from the Middle East.
No, and I appreciate, you know, you're looking for your townhouse and your place in the Hamptons and so on. It must be expensive.
His penthouse.
But when we're looking overall, a lot of prices in the United States in various parts, including in New York, have been coming down. Now, the price level is obviously going to be different from an area like the Middle East. You will see differences in the price level, but the inflation rate has actually become very subdued in cities like Chicago, Los Angeles, New York. Alaska has been having deflation recently, so absolutely falling prices coming through. So it's quite a wide range of experience that you've got in the United States. But lots of parts of the states, as I said, have got inflation sort of in the 2.5% to 3.5% range. Florida, unfortunately, is hovering around 8%.
So, Paul, how does the Fed solve a problem like Florida?
Well, of course, this is difficult. The Fed is looking at the economy as a whole, and it's got to try and decide where pressures are going overall. I mean, what I hope is that the Fed will take a look at the fact that wages, and I mean wages, not average hourly earnings, but proper wages, are slowing down. They're going to take a look at the fact that we know the fiction that is owner's equivalent rent, which is adding to inflation at the moment, that's going to come down in the future. And they will know that the lived inflation experience for a middle-income family that own their own home in the United States is actually significantly lower than the headline CPI. They'll know that they're in a more benign inflation environment overall, churn in the labor market is slowing down, and they'll call a halt to the rate tightening. The important point to remember is if the Fed, or indeed the Bank of England, pause on interest rates, policy still gets tighter. Central banks are still pressuring economies slower if they do nothing, because real borrowing costs are going to be rising over the next 3 months, because quantitative policy continues to tighten. Everyone's gone quiet on quantitative policy. It's the second pillar of central bank policy, and it's continuing to tighten. So they are still tightening policy, even if they do nothing.
Should they be more active in it, Paul? Should they increase the Fed at this next decision today? Do you think we could get a hawkish surprise in the way of QT?
I think that's unlikely. I mean, never say never with Fed Chair Powell. I mean, after the June policy errors last year where policy guidance was torn up, I would never bet against anything happening under the Powell Fed. But I don't think that's required because, of course, what's happening is the economy has slowed, but the economy is still growing, and it's growing faster than the Fed initially expected. Now, an economy that is growing demands liquidity injections, but the Fed is pulling liquidity out of the market. So what you've got here is the Fed's balance sheet as a share of GDP is falling faster than the Fed would initially have anticipated because the economy is doing better, the economy is demanding more liquidity, and the Fed is taking away the pinch ball. So I don't think that there's a necessity to do more on quantitative policy. I think the fact that the economy is growing and the Fed is pulling away liquidity at the pace that it's doing is creating enough of a slowdown in the balance sheet to GDP ratio.
Well, I think the Fed learned from a few fumbles in QT under Bernanke. Very quickly, Paul, oil, lots of debate, $100. Will it be a second round effect or for central banks, or as you say, actually, Manus, it's going to crimp the consumer more? Briefly, the take on oil.
So I think it's more likely to be growth disinflationary. This time last year, consumers had more savings. They could cushion the oil price. This time, I think you'll get two effects, cutting in non-oil spending, but also don't forget, oil is now more flexible as a form of demand. People work from home, you're not driving the car, oil demand goes down. Oil price up, more people work from home.
Although if you listen to a lot of executives, I should say, less folks are going to be able to work from home. Hey, Paul, I'm afraid we're going to have to end it there. Really wonderful to have you on the show, gearing us up for a big rest of the week. Paul Donovan of UBS Global Wealth Management, thanks so much. Now, coming up, we're going to have more on the market-moving events for you to watch throughout the day. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. Now a quick look at what's ahead today. Let's get you set up for your trading day. President Biden will be holding bilateral meetings with his Israeli and Brazilian counterpoints. That is at 10:15 a.m., 1 p.m. respectively in New York. And then we have today's main event. It's the Fed rate decision. That will be at 2 p.m., followed by Chair Powell's news conference at 2:30. Don't miss our special coverage. That will be at 1:30 Eastern. And then it's FedEx reporting its earnings after the market closed with eyes on any update on the carrier's cost-saving plans. Manis, before we can get through all of that, we have the Fed, and then we have the BOE, which, the way the market's trading, that could give us even more volatility than the Fed today.
Well, I think actually that Threadneedle Street probably needs to see a softer Fed and something from the PMIs tomorrow to perhaps help them. Danny, there is only one chart that defines rates risk, and it's at the short end of the UK curve. And this is where the CPI came in at the lowest level for 18 months, and down went the very short end of the curve, 2-year yields dropping, because there's going to be a very divided Bank of England tomorrow, according to Paul Donovan. Sterling's down by 1/8 of 1%. Of course, it's had a fairly good run from Trustonomics, but here you are. The gilt market now believes that the Bank of England, Threadneedle Street, have got the fodder that they need, the caveat that they need to deliver a pause. We need to qualify that pause.
Yeah, I'm still fascinated by what Paul Donovan just said to us, Manus, because we talk all the time about the ECB dealing with regional differences, that it's one policy for many nations. Well, what happens in the UK where you have beer, as Paul said, more expensive in London than East Anglia, which you're going to show it to me on a map after the show, and in the US where Florida is much more expensive than Chicago? How do you deal with that?
But then that is the conundrum. I mean, delivering an interest rate for more than 50 states, delivering an interest rate for the United Kingdom are two very, very different things. Rates aside, you're also seeing those US rates hit the highest level since 2007, and that was on the inflation pop that drifted over the border from Canada. So, you know, the nerves are jangling, and then you go into Bank of Japan on Friday, and I think that's all about the currency rather than the rates. What have we got on the pre-movers?
Yeah.
Instacart, they were brave, weren't they?
Yeah, I mean, IPOing in a Fed week. I mean, look, ARM went in the CPI week, so maybe they gave them the all clear, but we are now under $32 on the pricing for Instacart. It priced at $30 before the IPO. It went up to $34. Manus, we're kind of getting close to undoing all of that IPO pop.
Yeah, I mean, it was what, up 42 at $42 a share. They sold it onto the floor at $30. I mean, it was a monster one. Last week, the accusation was that ARM left too much on the table. There's a couple of other things just to keep your eye across. Keep your eye on NVIDIA, along with the automakers in Europe. That'll drift through on the EV story here into the US session. Let's see whether there's a nice bump on that. But tomorrow, it is all about the bond market, isn't it, Danny?
Yeah, we're going to have coming up on the Bloomberg Brief. We'll be speaking with Oliver Kettlewell of First Abu Dhabi Bank and Sarah Hewen of Standard Chartered. All right, that's it for the Bloomberg Brief. Surveillance is up ahead. Coverage out of London. We'll be talking to ARK Invest CEO Kathy Woods. Manus, good morning from London.
And good morning from New York.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He's
story.
there, the kind of upside.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It doesn't look like we've got a major issue with the economy at the moment. The economy's been relatively resilient.
Central banks have carved out in the last 6 to 9 months a focus on core inflation.
2024 should be a better year for earnings with the market.
We are seeing inflation coming back down towards where the Fed would like it to be.
In the end, higher for longer means there's going to be further tightening here in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The week begins right now, live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is positive by 0.2% on the S&P 500. Hours away, TK, from Chairman Powell and that news conference.
And it's a different news conference than it was a couple days ago. Between the United Kingdom inflation coming in a little bit. I love what Paul Krugman said. We'll talk about Krugman's essay on disinflation here in a moment, but it's a changed outlook to the press conference than it was even 48 hours ago.
I'm told that it's a coin flip going into the Bank of England tomorrow. I will say this, 7, it's not 7, it's 6. Bramo, does that make a difference to you? The good news is it's not 7. The bad news, it's still 6% inflation in the UK.
The idea here is UK inflation did come in softer than expected. This is a positive, but how much of a positive? And you raise a good point. To me, the key distinction here is that the core measure actually came in much more than expected. So stripping out food and energy. How much are we going to be talking about the difference between core and all-in, what you feel when you go to the store?
Well, that's going to be a theme today. I mean, we're there. We're there where we're slicing and dicing like David Rosenberg, what you do with inflation, disinflation, maybe parts of the world deflation. But the central bank story to me is they're completely data dependent, and that's what you're going to hear from the chairman today.
This market is running with higher for longer, that's for sure. Cycle highs on a 10-year yield in the last 24 hours, Lisa. New cycle highs going into this Fed decision. Crude at around 95 on Brent. We pulled back a little bit on WTI, but we're right there on crude. So the headline versus core conversation, how do they navigate that a little bit later in the news conference?
I'm not sure, because if you take a look at goods inflation, it's starting to reignite. And so at a certain point, oil feeds into that. The question to me is, how much is it being driven by demand? Can you be bullish on oil without being bullish on the economy, right? I mean, basically, aren't you seeing the kind of growth, which is the reason why people say, look, yes, yields are going higher. Yes, oil is going higher, but it is doing so because there is that demand, because there is that strength.
The heart of the matter, and to start strong today with Ben Laidler, I think says so much about how the gloom crew has gotten it wrong, is there's a resiliency to corporations, to market participants of working in a new interest rate environment. First thing I looked at this morning, John, the 10-year real interest rate, it's at that 1.9x level. To go through 2% is going to be a change agent if we see that this afternoon.
Are you throwing shade at Bramo?
No, I'm not throwing shade at Bramo. I just, you talk about disinflation, John. You don't see it on radio here, but behind John, John, I'm looking over at St. Paul's behind you, and there was inflation in the crumbs that they were serving tuppence a bag.
Right? Is that what you saw this morning?
I pulled out the farthing, and the farthing didn't go as far as they used to go.
Before we get deep in that nonsense, let's talk about a headline that came out in the last 24 hours. Amazon, holiday hiring. Bramo, 250,000 logistic workers. Pre-pandemic, that number was 200K. What was the number last year?
150,000.
It's getting better, right?
To me, this is actually really important. And there are people who say, well, actually, this is because more of the shopping is going online. Ironically, maybe people don't want to drive because gas is getting expensive. But either way, you're looking at a robust projection for a holiday season at a time where people are worried about that savings cushion supposedly going away. Where is that? It still seems to be there. If Amazon is hiring that many more workers and offering $1,000 to $3,000 bonuses.
So do the UAW workers double dip? Do they go over there and move boxes around while they wait for
I'm not sure
Detroit?
That's how it works, TK. We'll get you the latest update on the UAW negotiations a little bit later this hour. Let's turn to the price action on the S&P 500 this morning. And good morning to you, up by 0.2% on the S&P. Yields pulling back just a little bit. We're down 2 basis points on a 10-year to 4.34, but had a little look at cycle highs in the last 24 hours. And Lisa, if you want to blame something, I guess the move started after Canadian CPI.
Yes.
This was down to Canada, apparently, in yesterday's session.
And it came in lower than expected, kind of similar to what we're seeing in the UK. Today, the focus really is going to be on that 2 p.m. FOMC rate decision, followed by Fed Chair Jay Powell giving that press conference. The forward look, the statement of economic projections, the dots, The concept there is what people are really going to be watching. A hawkish pause. God, we're going to have to be talking about that in the band that Tom created in high school today.
Is this 6:30 p.m. tonight? Are we into the surveillance sleep, or are we doing this?
We're doing this. We're going to be here.
Yeah, my people haven't told me.
Special is happening.
1:30 p.m. Eastern or 6:30 p.m. British time. Meanwhile, today, Bank of America CFO Alistair Borthwick is going to be speaking around 7:15 a.m. Eastern time at a Bank of America Financial CEO conference. JP Morgan CEO Jamie Dimon speaking at the Detroit Economic Club at 1 p.m. I am curious how much they indicate that this strength has further room to go, and the savings cushion. Do they push back against that at a time where it seems like people are getting raises and can actually push forward?
I'm interested in the fact it's in Detroit. Just kind of timely, right?
President Dimon, do you think that he's going to be trying to do this?
I'm not saying that. I'm just saying it's a timely conversation,
it is.
Given what's happening.
How much is he going to weigh in on this? He's been known to be rather blunt, so it'll be interesting to see whether he comes out. And aftermarket, we do get some earnings, including from FedEx, which has gotten a boost so far this year from Yellow and UPS and some of the union negotiations there. I'm curious what they say about their labor and potential negotiations.
Always important.
Lisa, thank you. Joining us now, Ben Laidler, Global Market Strategist at eToro. Ben Laidler, constructive on this equity market. Max Kettner, HSBC, sat in your seat yesterday. He said we need to think about what could go right next year. You're the master of what could go right. What could go right?
Wow, you want me to give you the whole list?
Is it that long?
Listen, we're living sort of Goldilocks macro, right? I mean, you know, growth is a lot better than we thought it was, and core inflation, you know, it continues to fall, and I'm pretty comfortable that that's going to continue. That has taken the biggest risk off the table, which I think has given the rally you've seen this year, which is that the Fed was going to have to keep hiking whilst inflation was sticky and sort of drive us into recession. That's now gone, and the earnings cycle is now turning up, and it doesn't have really very much to do with the real economy. It's very tech-led. Inflation is now falling enough to take the pressure off profit margins, and probably the third and least important one is that the economy is sort of hanging in there. So looking forward to next year, which I think is going to drive this sort of fourth quarter rally, is return to double-digit earnings growth, and the Fed and frankly the rest of the world beginning to cut interest rates and keeping valuations high.
I want to go back to your process, and he mentions Max Kettner of HSBC yesterday, which I think the dovetail here is really important. You say right now the wall of worry remains high. You are the ultimate anti-gloomster out there. In late 2018, I believe it was, what was your process to push against the wall of worry then? What's the Laidler process to stay bullish and resilient?
You just got to look at what really matters. I mean, there's always a wall of worry by definition. The day there isn't is when we're all just, horrendously complacent and we're about to sort of trip over our feet. But, that wall of worry is huge right now. I mean, we're worried about bond yields at, 4.3, 4.4%, even though we're getting no validation from break-even inflation. We're getting no validation from sort of copper prices. This is classic U.S. sort of exceptionalism. UAW strike, yes, a third of U.S. manufacturing is autos, but we probably need a bit of a slowdown right now. And you can say the same about, potentially a government shutdown. It's an unorthodox way to slow the economy, but hey, maybe that's what we need right now.
Okay, everything that you just said, and I specialize in worry, would make me very worried. And I will tell you that person after person has come on this show and displayed an amazing display of lack of worry. Not only that, but you can see, yes, exactly what you're saying. Yields are high, and people have seemed to be shrugging it off, saying that we have already seen the bulk of the effects of monetary policy tightening. So doesn't any of this stuff catch your eye and make you think that maybe we could see some of those lag effects pick back up next year?
Yeah, totally. This is as good as it's going to get for the U.S. economy. I mean, the nowcast, the Atlanta Fed is nearly 5%. Unheard of. That's absolutely going to slow from here. The impact of 5% Fed rates is coming. It's just delayed because, corporates have refinanced and mortgage holders have 30-year fixed rates, but it is coming, and the slowdown will come, except it's a soft landing, it's not a hard landing.
So are you saying that slowdown has already been priced in, or do you see that actually coming in the prices in certain pockets, albeit not big tech in the U.S.?
I think it's more a sector argument than a market argument. I mean, why am I not jumping into growth cyclicals to small caps? And the market is sort of nibbling at them, but they're not running away with you, and I think that's your biggest tell. that the market doesn't think that this growth story is sustainable. This keeps me in sort of long duration. I know some of these long duration assets, have been a tough slog, but I do believe the underlying pressures of inflation continue to ease. Growth will slow. The laws of economics are not broken, and therefore, stay long tech, stay long bonds, stay long these long duration assets.
Stay out of Europe.
For now, but I think Europe's going to be the surprise next year. I think, Germany is pretty miserable right now and is leading Europe into recession, but give it 6 months and I'm sure we'll all be talking about the German recovery and, how that cyclicality works both ways.
Is that an FX trade or an equity trade?
I think it's probably an equity trade. I think central banks are super interesting. I mean, the Bank of England's about to go on hold. That leaves us with 3 of the top 4 central banks in the world on hold, waiting for the cut, which will take a while, but will come. And then, this weird outlier in Japan where they haven't even started hiking yet.
That's a story for Friday, TK.
I noticed, and John has been very good on this, for example, the luxury pullback. Bernstein was out today saying in some ratios, luxury is already back to 2008 levels. Have we had a correction, even if it's not a market SPX correction? Have we had in certain sectors substantial enough correction where you say, wow, there's value?
Yeah, we're definitely seeing it. And, the consumer is not sort of homogeneous. I mean, we are seeing, you mentioned Amazon earlier on. People are shopping online, they want to save money, and they're not They're shopping less for luxury, they're shopping less in department stores, they're buying less big ticket, so credit-dependent items. So, there's a lot going on under the surface here, but and you're seeing that play out in luxury, and, LVMH has been dethroned as the biggest stock in Europe.
In a Laidler bubble, what are you hearing from institutions? Are they buying the Laidler optimism, or is everybody under the table at Claridge's hiding out in 40% cash?
I think institutions have been late to this party, have been late to the rally. I think everyone else, whether it's corporates or retail, has been out front or never gave up.
Why is that? Why are you, wait, the institutions are the smart guy, right? You told me that, John.
I never said that. They're called the smart money.
Why are they behind?
Good question. You'd have to ask them. But I think sentiment's moved a long way. I don't want to say everyone's bearish, but to the extent people are bearish, it's sort of long-only institutional managers that I think have been very late here. And and one of the reasons I think you got a fourth quarter catch-up, right? I think people look at that year ahead and think, do I really want to be carrying 5% cash?
That's the classic Laidler charm there. Why he's beloved, long only buy side.
So one thing that you said in there, Ben, and this kind of feeds into tomorrow and the Bank of England, you said they're going to be on pause. And that is essentially what people had interpreted with today's lower than expected inflation read. Is that basically what that means? That anything that comes in disappointing, the balance of risks is, oh God, we can't do anything.
I think they're going to do a sort of 25 basis point last insurance hike, and then they're done, right? To your earlier point, I'm not cracking the champagne open that inflation's only at 6% in the UK. That still leaves us with, the highest rates of any market we want to be compared to, and the highest inflation of any market we want to be compared to. But it's a step in the right direction. Markets trade on the incremental data point. They're going to watch and wait, right? Everybody's data dependent. If the numbers, don't come through, then, maybe there's another hike there. But I think the base case is one more hike and they're done.
That's tomorrow's story. Ben Lader, thank you, sir. of eToro. Later on this afternoon, the Federal Reserve. Front page of the business pages here in the United Kingdom. Rishi Sunak, the British Prime Minister, under a little bit of pressure, supposedly because he's about to push out the ban of gasoline vehicles, Tom, back to 2035 instead of 2030. The first question I had this morning, reading the pages, who's next?
Yeah,
it's the reality check
agree.
for Sunak and for pretty much everybody else. And this transition's going to take longer.
And I think it's almost our secondary theme on this Fed Day Wednesday because it's just so important to see the retreat of elites in the United Kingdom. Granted, it's take the x-axis out. I don't see any concept retreat. But you wonder what's behind it if the people still say, you're kidding me.
On a practical level, the policy uncertainty for big auto manufacturers just continues. I mean, Ford came out and said, wait a second, whoa, we're making this huge investment on electric vehicles. You got to stay the course with all of your incentives and your plans. This is a very tricky thing.
Do we want, there's a lot of electric vehicles in London. That's my observation.
They're expensive, Tom. They're expensive.
Yeah. I mean,
how are we having a conversation about a cost of living crisis at the same time as trying to get people to
totally agree.
60, 70, 80.
I mean, those cabs cost a fortune. Those Chinese cabs made in Coventry.
Patrick Armstrong of Parimi Wealth coming up in the next hour. Your equity market positive from London. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Will the Fed hold rates steady as expected?
The Fed trying to back into the shrubs and disappear.
They're as data dependent as we've ever seen.
And will they keep one more hike in the dot plot?
The services prices are going to be a concern.
There is this risk. Maybe inflation starts to pick up again.
Trust Bloomberg for the fastest coverage and exclusive analysis.
We could see more headwinds.
They may actually tip the economy into recession before they start cutting rates.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Context changes everything.
I think this one's going to be a major oil spike either. I think we are going to find that the demand responds pretty quickly to these price hikes, and it slows down, and oil prices come back down, not dramatically, but at least they stop going up.
Yardeni Research President weighing in on this crude rally in the commodity market this morning. We're negative 0.8% on Brent. We're down more than 1% on WTI. The call on this program earlier this week, and read a set of energy aspects looking for triple digits in the next couple of months. Equities right now going into that Fed decision shaping up as follows on the S&P 500, positive by 0.2%. Yields a little bit lower, backing away from cycle highs on a 10-year, 434.27. We're down a single basis point. And there's that move in crude, Tom. $90.22.
Maybe back a little bit, $1 or $2, whatever, but still elevated to say the least. And then there's 18 shades of crude above that, including Brent crude, the global price. Because of time, we're going to get right to this. When Javier Blas walks into a room at some confab of the great and worthy stop. He is encyclopedic on global oil. His book won all sorts of awards, The World for Sale, and he joins us here with his great effort for Bloomberg News. Javier, my book of the year is Robert D. Kaplan, The Loom of Time. It's about the greater Mediterranean on out east to Afghanistan. And the single best chapter in it is Kaplan's huge clarity on the Saudi Arabia we think we know, but it's not the Saudi Arabia of our youth. What does the new Saudi Arabia look like in terms of oil? What is MBS doing on oil that we need to know about?
I think that when you think about the new Saudi Arabia, you could just think about two words that many leaders in Saudi Arabia use today: Saudi first. And that really shapes oil, shapes geopolitics, shapes power, shapes the economy. Every decision they're going to take is going to be thinking about what matters for Saudi Arabia, thinking about Saudi Arabia first. And on that sense, they really want to keep prices as close as they can to $100. They say they don't target oil prices, and well, the truth is they do, of course, target oil prices through supply, demand, and inventories, and they're trying to keep prices as close as $100. That's what is good for Saudi Arabia. That's why it comes Saudi Arabia first.
Do you see in all your work, and particularly looking at their marginal desire to stay at $100, that will reduce demand? If we have $8 gasoline, petrol in the United Kingdom, if we have $5 plus petrol in the United States, does it reduce demand?
It will reduce demand, and obviously it could contribute to higher inflation, higher interest rates, and therefore lower economic growth. So the Saudis are playing a very difficult game of how high they can get without triggering the negative consequences. So far, it has been good for them. Demand seems to be holding. There is a lot of talk about weaker demand, but in the reality, it's like this recession in Wall Street that has been coming for the last couple of years. In reality, demand is fine. We are at 103 million barrels a day. That's an all-time high. Demand has increased year on year by about 2 million barrels a day. That's historically very good. 2024 is a bit of a more question mark. The Saudis are running into risk, but so far it's working for them.
Are you suggesting they have a higher tolerance for economic stress abroad now?
I think so. I mean, in the past, the call from the United States will have been already been made, and the Saudis will have acted, and it will have not really let the oil price to go much higher than $100. And at the moment, they're just not picking up the phone the way that they used to Washington, because they are putting it all and foremost their national interest first. So yes, I think that if the U.S. is suffering, the Saudis are going to say, well, you need to do something about it, then we can help later.
What do you think underpins that change? That breakdown in that phone call that used to happen between the White House and Riyadh?
I think that above all, the Saudi Arabia needs the money. If MBS, Mohammed bin Salman, the Crown Prince, wants to transform the Saudi economy, he needs the money.
So it's not international politics, this is finance?
I think it's just finance, and I think it's a lot of it is national politics. It's about what the Saudis need. I was in Riyadh earlier this year, and I was, in the outskirts of Riyadh, there is a new capital emerging, it's Al-Diriyah. There were 60 cranes, construction cranes. That is costing a lot of money to the Saudis.
Which raises a question, if they're really looking for targeting that $100 a barrel, does that mean that oil prices can remain high even without the growth to underpin it? That basically Saudi Arabia will cut production enough to achieve that regardless of the backdrop?
No, I think that the commodity cycle and the economic cycle is always going to play a role. And if the global economy weakens next year, then the Saudis are going to have to accept lower oil prices. They already cut production significantly this year. They are producing 9 million barrels a day, which is relatively low for historical standards, at least for the last 10 years for the Saudis. And that in part was to accommodate a huge increase in Iranian production, very quietly, not making much noise. But Iran is this year the second largest source of incremental oil supply into the market. So the Saudis have accommodated that. They cut production. I don't think that they can continue cutting production even deeper into 2024 if the global economy weakens. But certainly they are going to try to keep oil prices as close as $100 as they can. And let's not forget, for Saudi Arabia, on Arab Light, which is the benchmark that they care, the price is already at $100.
There's also a question about other areas of production, in particular the U.S., which has been serving up a record amount of production. There has been question about how much that can increase. How much is that a swing factor that could materially alter the price going forward?
It is a massive swing factor. We have seen that the moment that the price of WTI, West Texas Intermediate, has gone above $90, we have beginning to see an increase in the rig count in the United States. But clearly, there is a question mark whether we are going to see, more U.S. production. At the moment, what we are beginning to see is a plateau.
Javier, I want to be very quick here. We're in Davos, the great and worthy were assembled. Javier Blas walks in, the room falls silent. At the table next to you is Savita Subramanian of Bank of America. Folks, she lifts her S&P call today. Subramanian was ordered by Brian Moynihan to do ESG. She did brilliant mathematics on ESG. Is there a new ESG? When you see Sunak in London capitulate, when you see what happened at British Petroleum, is there a new ESG out there?
I think that we saw peak ESG about 18 months ago. I call it a bit the ESG bubble, and reality is starting to sink in. We have seen Prime Minister Sunak watering some of the commitments on net zero. And I think that we are going to begin to see more leaders. It's difficult to meet net zero. It's going to be costly. The easy part, the low-hanging fruit, has been done. Until now, it was all win-win. It was green and cheaper. Now it's just more difficult. It's a lot of trade-offs. It's going to be green, but a bit more expensive. And we have not yet had that conversation with the voters. We said to everyone that this was great. It was going to save the climate and bring prices down. Now it's a much different conversation. I'm not saying it's wrong, but it's a different conversation.
It's changed big time. The question I asked this morning, Javier, who's next? Who's going to push out some of these targets?
I think that we have already seen Japan within the G7, and I think that Germany and France are really on the fence.
Yeah, Javier Blas of Bloomberg. Javier, thank you. Just some news coming out of the UK. This from Goldman. UK interest rates have peaked. Their line reads as follows. The BOE likely to keep rates on hold tomorrow. Consensus for tomorrow was a hike from the Bank of England, 25 basis points. We spoke to one guest who suggested you get a hot print, they might be going to 50. Maybe now, Lisa, after that downside surprise, this Bank of England backs away. That's the call Goldman is making this morning.
Which is the reason why the pound is softer versus the dollar. But if you think about it, this is kind of counterintuitive, because if you think inflation is actually coming down, shouldn't it be stronger if that actually gives more of a pass? I mean, this is where the currency differentials are really kind of raising some questions.
I guess this morning, at least, the explanation is you lose some of that rate support. You've got the two-year yield down by about 13 basis points, Tom, and sterling weaker off the back of it.
Yeah, and some of the forecasts out, you follow them more than I do, John, because you're paid in sterling and you really care about it. But the answer is we're down to 120, and we had something the other day. We had somebody the other day talk parity. You turned white.
Parity on euro dollar, not on pound sterling against the US dollar. Yeah,
I mixed my pairs.
Different.
Thank you.
Different currency pair, TK. Alsa Linios will straighten things out of RBC on the FX market. Alsa's going to be joining us next. Your equity market more broadly on the S&P, positive here by 0.2%. Your Federal Reserve decision a little bit later for the Bank of England tomorrow. Goldman Sachs says no hike.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
New price target at Bank of America, 4,600. Savita Subramaniam, the upgrade, up from 4,300. Right now, equity futures positive by 0.1%. More on that upgrade a little bit later. On the Nasdaq futures positive here by 0.14%. A sleepy, snoozy start to the week. Several central bank decisions coming up a little bit later. The Federal Reserve this afternoon. Bank of England tomorrow. A feeling that things have changed over at the BOE, given that inflation print a little bit early this morning. Goldman first out the gate to say we are done. No hike coming tomorrow morning. More on that a little bit later as well. Let's turn to the bond market. 2-year, 10-year, 30-year. 2-year yield in America in the Treasury market still north of 5% and very close to cycle highs. On a closing basis, a new closing high, a new cycle high on a 10-year, just short of that now, down about a basis point or two to 434.27. I just want to finish on foreign exchange, turn to the euro just briefly. The euro shaping up as follows against the dollar, 107 and positive by 0.2%. That's the cross-asset price action. Under surveillance this morning, the Fed expected to hold rates at today's 2 p.m. Eastern decision. However, investors waiting on clues from the so-called dot plot and economic projections as a tight labour market and crude prices add to inflation pressures. Chair Powell's news conference kicks off at 2:30. Our coverage begins at 1:30. Might as well bring you the lineup. Stacked show, TK. Kathy Jones, Charles Schwab, Matt Lazzetti, Deutsche Bank, Diane Swan, KPMG, Citi's Andrew Hollenhorst, Citi, alongside Mike Gapin at Bank of America, believe. We've got one more to come here, and that one more comes in November.
What's important here are some real eclectic calls, not only on the real economy, but also on the rate guess that everybody's making. I'm fascinated, as you mentioned, Subramanian in the equity market, how people are amending, and directionally to see Hollenhorst come in would be important. We haven't seen that yet.
Let's turn to UK inflation, falling to the lowest level in 18 months ahead of the BOE decision on Thursday. CPI coming in at 6.7% year over year versus the 7% expected. Sterling weakening to the lowest level since May as traders pare back hike bets. And that paring back of hiking bets, Tom, goes to Goldman Sachs. Goldman say we've peaked. Goldman say no hike tomorrow.
For a U.S. audience, what's important here is to triangulate. And like euro-yen, we across the pond have you triangulate to euro sterling. They're both weak versus the U.S. and that tug of war. How does that play out, John? You follow this day to day.
So Lisa raised this question, and I think it's a really important question. Should sterling be rallying off the back of no more hikes, given that we might not damage growth anymore? And I don't think the answer to that is as obvious as you think. This morning, it's fairly intuitive. You lose some of that rate support. The front end of the curve rallies. We're seeing that in the UK 2-year, and sterling weakens off the back of it. But do we have a better outlook for growth off the back of a Bank of England, Tom?
Well, that
might be done.
This is the ambiguities. And, you know, Matt Lazzetti, just as one example, with us this afternoon on our coverage, he said, yeah, there's going to be a slowdown, but his brilliant call was to push it out from his original call. He said, this is out a long way out, and we're still waiting, and we've been wrong on a UK slowdown. You look at something like the GDP input to Newcastle of that game last night.
I'm not talking about that game.
That moves the needle up.
There will be no conversation about that
There'll be no
last night. We're done with that.
What else
did you
do
get any
we
Instacart shares? Did you get any shares?
No, I did not. You got your usual 8,000.
Instacart easing in this morning's trading after gaining as much as 12% in Tuesday's debut. The IPO raising $660 million, marking the year's 4th biggest public offering in the United States. Semiconductor designer Arm raising $5.2 billion last week in the biggest listing of the year. Can you take any signal from this, TK? These two listings we've had in the past week?
I believe it was Zero Hedge. Had great charts last night. Arm goes up, enthusiasm rolls over, and it sells back to the initial opening price. And for both of these companies, very different. You know what it's about? The first conference call. That's really what this is about. You get away from the hoopla, and you get out the first call, second call, third call. And then
those quarterly earnings.
Quarterly earnings.
Like the questions from the analysts.
Do you think they understand they've got to go on the phone and explain what's going on?
I think Arm understands that. Instacart might have to figure that out.
Yeah.
Arm's got a history of doing that, Tom, as you know.
We are having fun today. It's an extended day for us here in London. It's been wonderful. Our team's put together a great eclectic set of voices for you to frame out, the path to 2024. Elsa Lingos is hugely qualified. Global head of foreign exchange strategy at RBC, tour of duty, working in Europe with different institutions to look at the political economics of the moment as well. You know, to you, I can say, like, what's Euro going to do or what's Sterling going to do? What are they going to do if they actually get disinflation? Can you call a disinflationary trend in place yet?
Too soon for that, but I do think this morning's CPI data will be very welcome news from the Bank of England perspective, because they'll feel like finally their policy measures are biting and they're removing some of that tail risk of stagflation.
How many months or quarters do you need to establish a disinflationary trend? Not the data dependency, the media's focus on one surgical point, but what's your timeline to say trend in place?
Well, I think it's also the composition of inflation, right? Because we've seen headline inflation come off on energy prices. In fact, if anything, now ticking back up again, as we saw yesterday in Canada. So really what we're focusing on is that core measure, or even more so the super core measure. What's happening to those demand-driven components of inflation? And are those weakening enough to signify that we're going to get to target?
And Paul Krugman with a brilliant essay out, folks, wheelhouse for the Nobel laureate on trends. He looks at disinflation, and I love what he says about plain vanilla inflation. John Farrell's family in England is living plain vanilla 6% plus inflation. Do people like you and these elites, do they look at plain vanilla inflation?
I mean, you see plain vanilla inflation across the board, right? And I think that's the important part about the current rise in energy prices. Because for all that central banks like to look through those and focus on core inflation, if headline inflation goes up, comes down a bit, goes up again because oil prices or commodity prices don't really come off, what does that mean to your average consumer? Their kind of lived experience is that prices just keep going up.
I can't believe we're sitting here and we've got this note from not the Bank of England, from the Goldman Sachs team on the Bank of England, suggesting we're done here when inflation is in the high sixes. Can you make sense of that for our audience? If we were in the high sixes in the United States, we'd be talking about the prospect of a 50 basis point hike from the Federal Reserve this afternoon. Why are we talking about the Bank of England being done with inflation in the high sixes and wage growth pushing 8%?
I think it's the wage growth that's more important, right? Because don't forget, the Bank of England looked through high inflation in the immediate aftermath of the GFC. And there was a long period where Mervyn King was writing regular letters to the Chancellor about inflation being outside the target band, and yet, you know, they were happy to leave it whole zero. It's that which is the difference. It's the fact that they're happy to look through it if they feel like their policy is working. And I will say this morning's data do make tomorrow's decision much more finely balanced.
Simon French of Panmure Gordon was in your seat yesterday. He suggested that this Bank of England has a communication problem, a credibility issue. Do you agree?
Yeah, it's hard to say they don't. And I think more than anything, it's the inconsistency in the messaging that people struggle with. I mean, sure, this is a particularly difficult time to be forecasting. I think economists have struggled with that on the sell side and the buy side. But from the Bank of England's perspective, it's the fact that that message seems to change every month, rather than just sticking to this data dependency mantra.
You speak 14 languages. You've got parchment and physics from Cambridge. I want you to talk about the physics of Christine Lagarde's speech at Jackson Hole. You've lived the ECB theory, the ECB process, if you will. Is there any hope and prayer that the ECB can get away from the data dependency that she despises?
Sadly, not really. And I think the reality is that you've got so many competing views on Governing Council. You saw that just over the weekend, right? They had that announcement last week, and then they already came out with voices saying, oh, we should be doing more, we're not quite done yet. And it's that kind of cacophony of voices which ends up with the data dependency.
Well, you two are expert on this, John. You've lived it as well as Elsa. And what I find fascinating here is the simplistic American view of Bundesbank versus Portugal. Now, it's not that way. You both know it's richer and more complex. To be honest, my good friend Christine Lagarde doesn't have a chance on this. There's no chance that they're going to take a more holistic, longer Philip Lane trend.
Here's the difference.
In policy.
Under Draghi, who was not a consensus builder, he would bully the Governing Council into a corner and say, we're doing this. And he'd have to get the Bundesbank to come along. Lagarde is a consensus builder, but she gets an easy time of it now because Germany's the weak spot. Germany's the weak spot.
Do you agree with that?
And what I don't hear from the hawks on the Governing Council, they're not screaming rate hikes. They're not screaming rate hikes at all. So how much of a deal was there actually to strike on the Governing Council last week? People make out there was a deal between doves and hawks. The hawks that I'm hearing from aren't that hawkish at the ECB, are they?
Well, they're a lot less hawkish than they used to be because, as you say, Germany itself is feeling the weakness. But also Draghi, in many ways, had to do that, right? Because it was a crisis situation, and that forced his hand. Whereas now, we're not really there. We're kind of in a situation where central bankers have a bit more time to assess, to be data dependent, to build that consensus.
I teased this a little bit earlier when we were assessing what was happening with sterling. And Lisa raised the question, I think it's a really important question to ask regarding the UK and sterling, but I think we can take this broadly to Europe and the euro. How important are rate differentials for currency pairs at the moment? When you see developments in the UK, is this kind of development meant to be sterling weaker or sterling stronger? What does it mean?
Fully agree with Lisa that it's ambiguous. Right, I've heard a lot of people, probably more from the sell side than the buy side, trying to talk up sterling as this carry trade. There's much better carry out there. I mean, if you really want carry, you're going to Mexico, you're going to Brazil. Like, the UK is not necessarily where you're going to get it. But at the same time, the fact that, like I said earlier, you kind of remove some of that tail risk of stagflation, that's a good thing. And from a policy credibility perspective, it's good that the Bank of England is finally, seemingly, getting inflation under control.
What is your question for Powell today? You're in the press conference. McKee gives the last question. They go, Lingos, you're here. We'll give you one. What's your question to Jerome Powell today from your EU perspective?
I'd be really interested to hear how he's thinking about the run-up in energy prices and the feed-through that will have to headline inflation.
Well, wait. Well, stop the show here. Halima Croft. Okay, you've got someone who's pretty good at this, right?
Yeah.
What does the wonderful Halima Croft... Halima, wonderful to see you. Thanks so much for stopping by. Halima Croft, what does she say about this move to 100?
I think she's been bang on the money with that call. Now that we're there, it becomes a lot less obvious that we continue further from here. But she was very open and talking a lot about it earlier in the year, and the markets were just ignoring it for a while. They were ignoring the supply cuts, the production cuts. We're here now. We feel the impact.
Can Powell ignore this later on this afternoon?
I mean, let's see. It's a very short intermeeting period between September and November. December is probably the time they need to make that call.
Do you think the Bank of England can ignore it a little bit more? I'm just wondering, who is this more important to? Governor Bailey?
Ultimately,
Ueda? Powell?
Ueda, we can almost forget about. The Bank of Japan are not doing anything anytime soon, and even when they do, it's going to be tiny. Now, I'd be most concerned in the ECB's position. Energy importer, you still have that regional difference between US energy prices and European, and they're the ones really that are facing the economic weakness.
We are staggering beyond Duesenberg. Through Trichet, John mentions the wonderful Draghi of Italy and now Lagarde. Is the ECB a more mature institution now, or are they still making it up as they go, as they did when Marsing was there?
Absolutely more mature, and you've got to remember they've been now in existence for over 20 years. They've been through several crises that's knitted them together, but more than anything, the fact that it's the core now feeling the weakness, I think that
John mentioned that.
Naturally brings
I didn't
them
mention
together.
that. John mentioned that.
Jane Foley talked about the prospect of parity on the euro in the new year. Are you going there yet? Can we finish there?
Come, we got some news. Come on.
We've had 104 for year-end forecast since the start of the year, and that hasn't changed. But we looked into 2024 and actually said, why should it stop here? Why should it bounce back? We've got 102. Could we get to parity? Sure, maybe. I just don't think we'll stay there long.
Okay. Alsa, thank you. That's quite a call so far in the year. We'll see how we end it, but quite a call so far. Alsa, thank you. Alsa Lindros there of RBC. They've got 104. We're trading at 107. 104 was quite a call at the start of the year. You have to imagine, go back to the start of the year, all the happy talk around China reopening, what it might mean for Europe and TK. That story is not the story going into year end. In fact, Lagarde talked about that in the news conference of the ECB just last week. The tailwinds at the start of the year, China reopening, lower energy prices, they have gone and they have developed into headwinds going into year end.
Yeah, and I think into these 3 central bank meetings, what our audience needs to pay attention to is this is a movable feast right now. There's no cast in stone belief going into October, dare I say, to that Fed meeting in December. We're literally, John, making it up as we go. And it feels that way, folks, putting the show together. Day by day, we're making it up.
Day by day. I think we can say the week begins today, a little bit later on this afternoon. Chairman Powell, a decision from the Fed, non-decision for many, no change expected. The forecast will be closely watched, changes to growth projections, inflation, the dot plot as well. Then it's on to the Bank of England tomorrow and the Bank of Japan on Friday. To preview all of that, Bruce Kasman, JP Morgan, looking ahead to those 3 central bank decisions. He joins us next, live from the City of London for our audience worldwide. Good morning.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Three big days coming right up. The Federal Reserve a little bit later on this afternoon, the Bank of England tomorrow, then on to the BOJ, the Bank of Japan, and Governor Ueda on Friday. The price action set up as follows, going into all of that on the equity market. Futures, just a little bit positive here by 0.2%. Yields coming in, TK, a couple of basis points. Your 10-year, 433.
The price action here that matters is, can John get decent tickets for Arsenal-Tottenham on Sunday? What do you think?
I'm trying to hook it up.
Yeah.
Arsenal's the home team, though.
What I find, and this is the only city in the world where I religiously take taxi cabs. I love them. If you mention English football to anybody driving a taxi cab,
yeah, they've got a team.
That's entertainment. That's entertainment for the whole trip.
I prefer the West Ham fans.
Yeah.
The West Ham fans, probably East London cab drivers who have got things to say about British football.
I've had so much fun with this. We're going to pause on this right now. Bruce Kasman coming up here in seconds on an important day, important conversation with Dr. Kasman. I had so much fun last night following a boring 0-0 game. It wasn't boring. What is the symbolism that Newcastle went in there and survived AC Milan?
Pretty impressive. They've not been in the Champions League for about 20 years. So to go to a stadium like that, and for some of those players, Tom, they probably never thought they'd be playing an occasion like that.
To walk on a field like that, yeah,
like
very
that.
cool.
To walk out to 80,000 fans, and we talked about the atmosphere and the acoustics of the San Siro, to survive that. And they did survive an onslaught. Compared to the shots on target in Newcastle, I think one
Oh, it's
for
terrible.
AC Milan.
It's completely one-sided.
Completely different in terms of the statistics. But yeah, they got out of it alive, and fair play to them.
And just to educate idiots like me, they do it again at Newcastle.
There will be a return leg. I think that return leg is in December.
Yeah.
But the challenge you've got, TK, when you're new to the sport, is understanding the tension of European football, understanding the tension so that you can enjoy.
Is it nationality in cities and, you know?
Yeah, the tension between the two clubs.
I
but
don't
also
see
the
it
tension
anywhere in
within the game
America.
itself.
Anywhere in America. Maybe NBA, but not even there.
I was always told that Americans didn't like European football because it was too slow and low scoring. And then I look at American football, Tom, and the ball is hardly in play.
Oh, they've ruined the game.
And all you've done
Don't
is
get me going.
call one goal, 7 points.
Yeah.
What's the difference?
It's run by committee
I'm going to
now.
get so much hate mail a little bit later.
No, but what's
that.
important on this, and this is the change, what we hate about English football is everybody falls down and gets hurt. And they've really diminished that.
They need to clean that up.
They've cleaned that up.
And I think the officials, the referees, are going to try and do something about that.
There's your football moment for the day. We're having a lot of
We
fun
are
here
done.
in
No
England.
more Newcastle AC Milan.
Doing
no
this.
more of that.
As John mentions, the week starts today. For Bruce Kasman, it does not. On Friday evening, Kasman, along with the dreaded Dr. Ferroli and others, put out their weekly prospects. The way things are moving, it could be daily prospects. Kasman of J.P. Morgan joins us this morning. Bruce Kasman, what will you listen for from Jerome Powell today?
Well, I think the issue really when the Fed certainly stays on hold and certainly also continues to maintain a hawkish bias is how on this color are we talking about their confidence that they're done here. And I think, of course, they're going to continue to maintain that bias. They're going to give us some sense of progress on inflation, some ongoing concern. I don't think we're going to get a strong message. And quite frankly, I don't think it's going to tell